We still think tech is the dominant theme of this bull market.
Equity earnings will always drive the market.
The concentration in S&P has gotten pretty high.
There could be a near-term correction.
It'll be a broader rally from here going forward.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, crude inching lower. Iran claiming major progress following peace talks with the US. Just days away from getting the latest read on inflation in America. Treasury yields are kicking off the week near the highs of the year, the 2-year through 420. And Bank of America now looking for 75 basis points of hikes this year.
Yeah, that follows on from what we saw from Deutsche Bank with 225 basis point rate hikes coming later this year. All of this comes at a time where you see 2-year yields at the highest levels they've been since February of 2025. Detaching from oil prices, this isn't just an oil story. It is a story of hawkishness by central bankers. The Warsh Fed is being viewed as decidedly hawkish. Yield curve flattening. Question, how far will they actually go?
If you're not going to offer forward guidance, be careful who you outsource it to. Later on this morning, we'll hear from Governor Waller. Later this week, we'll hear from Governor Williams. And I just wonder whether they'll be as reluctant to offer forward guidance around this Fed's next move.
And whether people take their forward guidance to actually having the clout that it has in the past. In other words, we don't have an understanding of what Warsh's power over the Federal Reserve actually is at this point. I hear there's a committee over that. I really do wonder how much some of these Fed members are going to defer to the committees, the 5 committees that potentially are going to study things like how they are going to speak to the public. In the meantime, there's so many questions around whether this is the right read, given the fact that right now people are taking this as unabashedly hawkish. 9 out of 18 members voting for the next move to be a rate hike. Nonetheless, who holds the power, who holds the cards at a time of committee drama?
Interesting timing for all of this. We've got Economies, Deutsche Bank, Bank of America lining up for rate hike calls later this year, just as crude drops into the 70s. Crude this morning, Brent 79, WTI around 75, and claiming major progress around talks that no one really on Wall Street wants to hear about anymore.
No one wants to hear about. The fact of the matter is, when you look at these negotiations in Switzerland, is really they just agreed to keep talking. They now enter, as the vice president called it, these technical talks. There was a line of communication that they've established between Tehran and Washington to make sure there's no misunderstanding. What matters for Wall Street is the fact that more vessels and more cargo and more product is getting through. CENTCOM talked about that over the weekend. And then this morning, what you see is Iran actually ramping up what they are openly sending out to the market on U.S. sanctioned vessels.
If there was a hierarchy of stories on Wall Street that people didn't want to talk about, Iran would be right up there, and the UK would be somewhere close, because people are sick to death of UK politics as well. Crude is in the 70s. Sterling this morning back to about 132. Sterling's hardly moving. Crude's hardly moving. These are the 2 stories people really don't want to engage with this morning, but let's engage with this one. A new Prime Minister on the cards. We've got a timetable for all of this, maybe as soon as September, perhaps even sooner than that, with Prime Minister Keir Starmer announcing his plans to step aside.
The likelihood is that Andy Burnham is going to come in later this year, although even his camp is saying, hold on a second, we need some time to get some proposals that we can actually deliver on. The market's not necessarily responding to this, although there already has been a response. Just to put into perspective the political dysfunction, and this goes on a broader sphere other than just the UK, but really highlighted here. Since 2022, there have been 4 prime ministers. This would be the 5th. Each one of them have lasted 2 years, 3 years max, 1 month minimum. Question here, how do you coalesce around something that actually is going to be lasting and that's going to come up with proposals to fix the doom loop of oil, of what you see with borrowing costs and what you see with the currency?
7th Prime Minister since Brexit. It's been really difficult when it comes to UK politics and just a level of dysfunction we have not seen. To your point, Jonathan, though, we could see someone sooner. And an individual speaking to Bloomberg is saying potentially we can have a new Prime Minister by July 17th or 18th if it's only one candidate. I think that's what everyone's going to be focused on. Is there really going to be a contested leadership race when it comes to, is it just going to be the Mayor Burnham, who's now being signed in as an MP, or potentially other individuals going to throw their name in the hats, or just maybe take other positions like the chancellorship?
You mentioned Brexit. Let's go back to that. It's almost 10 years to the day. For a heartbeat, that was a global story for a number of weeks. Then it became a European one for a number of years, and then it became a UK one. The Brits the only country left really talking about this anymore. This story this morning is highly consequential for the future of British politics and the British economy. With that, there can be no doubt, of course. But it's inconsequential for the rest of the world and for global markets, with one exception, the bond market. If something changes here, this can rattle fixed income elsewhere, and I think we should respect that. I have no idea what the plans are of the incoming government, what it looks like, whether it will be a shift to the left, or whether this bond market will push back ahead of time. 10's around 5% still, 30's through that level already this morning. And I remind you of the biggest failure of this current government was about a year ago when they tried to reform welfare. And the welfare bill became what was later called the zombie bill because they couldn't get it through Parliament even with an overwhelming majority. That's going to be the task this time around for a new Prime Minister if this bond market pushes back.
And how much is this purely a UK story at a time when developed markets around the world are facing off similar dynamics, albeit not as extreme as what we're seeing in the United Kingdom? But the idea that deficits have increased dramatically across the developed markets, and frankly, nobody wants to pay to actually reduce that deficit, and that has become an increasing problem for the bond market.
Futures this morning, equity futures down just 0.1% on the S&P. Coming up this hour, we'll catch up with Laurie Calvasina of RBC, with Wall Street awaiting a fresh slate of economic data. Conor Wayne Sanders of Bloomberg Intelligence as the roadmap to a final US-Iran deal takes shape. And we'll touch base with Jordan Rochester of Mizuho as the British Prime Minister Keir Starmer announcing his plans to resign. We begin this hour with stocks little change following 2 weeks of gains heading into this week's inflation data. Laurie Calvasina of RBC writing the sentiment story has been one of mixed emotions, with takeaways varying depending on which data set one is looking at. Laurie joins us now for more. Laurie, good morning. Good to see you.
Good morning.
Does the bull case stand up to the rate hike debate at the moment?
I think so, as long as you have a moderate amount of rate hikes. We talked about this in our weekly a few weeks ago, that whether you're looking at it from the perspective of the Fed taking their interest rate up or 10-year bond yields moving up, that when we go back and we look at the history, both since 2022 on the bond yield side, or if we look back to 1990 and look at sort of Fed moves over the context of 12-month moves in the market, everything in moderation seems like something the equity market can handle. If you go back to 2021, 2022, we priced in an enormous amount of hikes. We had a massive move up in 10-year bond yields. It was a real regime change. We've been sort of stuck in this bond yield environment on the 10-year yield side between sort of 3.3 to 5%. If we stay contained in that range, I think that we could have some short-term indigestion in markets, but still have a fairly good outlook over the next 12 months. Similarly, if you go back and you look at how stocks perform in different hiking and cutting cycles, your best environment is when the Fed does absolutely nothing, so we can keep our fingers crossed for that scenario. But you tend to get like 13 to 14% returns on both the hiking side and the cutting side when you're seeing moves in the 0 to 100 basis point range. So as long as we stay, within, say, 2-ish hikes over the next 12 months of 25 basis points, I think stocks will ultimately be okay. They may not like it in the short term.
Lisa mentioned Deutsche Bank looking for a call, rate hikes later this year. Bank of America doing the same. That note just dropped earlier on this morning. This call, this conversation accelerated by this move in energy, but energy's dropped back to the 70s. When you speak to the team at RBC, how dependent is the outlook for interest rates on what's happening in the commodity market?
So Blake Gwynn on our U.S. rates strategy team handles the Fed call for us. He's not currently looking for any Fed moves, though he has also written that his conviction in that has come down. And our econ team has talked about how the next move may be a hike rather than a cut. I think there's a lot of fluidity in the situation right now. One of the things that came out in my meetings with investors last week is just a lot of uncertainty is in the air, whether you're looking at the path of the Fed going forward, how the Fed is going to operate going forward, and frankly also the situation in the Middle East in terms of what that means for oil prices. What should your assumption be over the next 12 months? I don't think a lot of people know that, but that does have reverberations in headline inflation. One thing that Blake has really emphasized to us internally is that he hasn't really viewed the Fed policy rate as the appropriate path or the appropriate tool really to combat any inflation emanating from oil prices. But we do know, of course, that we have inflation emanating from other sources as well.
What's more important for the equity market, core PCE coming out on Thursday or Micron earnings coming out on Wednesday?
I think that this is a situation in the equity market where we have very, very strong earnings tailwinds that are running up against very stiff headwinds on the PE side. And you tend to get compression in the PE, right, when you have higher inflation, higher interest rates. But so far in our modeling, it looks like the earnings story is strong enough to offset those headwinds from compression. So I would say right now earnings matter more.
At this point, a lot of people keep talking about that. And yet, you take a look at some of the earnings, they've been driven by names that have pricing power. There is a bit of pushback on the pricing side in a significant way from hyperscalers and from other companies that are realizing that there are some limits we might be bumping up against. At what point is that a tension that needs to get resolved that could potentially be a risk factor?
So look, I think it is something that investors are already thinking about and digesting, which takes some of the edge off, frankly. I think we just have to go through reporting season, right, and hear what the latest commentary is from companies. One of the things we've talked about is the CapEx cycle, and we're getting a lot of questions on this last week. A lot of that is hyperscaler driven, is AI driven. If you look at rates of change on S&P 500 CapEx, you're kind of hovering around peak-like type levels. But if you X out the top 10 names, we're in the very early stages of a CapEx recovery cycle. So can you elongate the cycle as you get more companies participating in the CapEx boom? That's something we have to think about given the tax bill that we saw last year. So we're still sorting through a lot of these issues.
Are more companies going to be participating when it comes to doing better in the stock market, given they could put the Iran war behind them and energy prices are moving much lower?
So I'll tell you, Annmarie, last week the Business Roundtable put out the CEO confidence survey that they run, and we actually saw that tick up. And it was on the strength of CapEx expectations, sales expectations, hiring expectations were pretty neutral, but there's just really been a clear contrast between, say, investor sentiment, which has been kind of weak or meh. It's gotten a little bit better recently, but hasn't been that fantastic. And then if you look at the corporate side, things are, I wouldn't say they're off to the races, but are still generally optimistic. So I think we have to take some comfort from that, especially as we head into this next reporting season.
Can I answer the question? Can I just say Micron?
Yeah.
Right? Micron probably, because I think most economists understand where PCE will probably come in after seeing CPI and PPI in the last week.
Yeah, and how high expectations are from Micron, given the fact that it's rallied like some 800% in the past year. I mean, it's insane. You start wondering, can they keep having this transfer of wealth coming from hyperscalers to them? There was a chart showing the divergence in performance between the hyperscalers and the chip makers, and it's bonkers. I mean, it just shows what's going on right now, and it feels like maybe not totally sustainable in perpetuity.
Sometimes you just can't please some people, and they'll say things like, this is as good as it gets, even if it is so good. Have we seen peak as good as it gets?
So if you look at the rate of upward revisions for either the semiconductor companies or the S&P 500 in general, it does look like we've sort of hit those peak levels of earnings enthusiasm. If we looked at the S&P 500, the rate of upward revisions, I think it got to around 89, 90% recently at the high. The high tends to be kind of in that 90 to 94% range, and in our latest update, it ticked down to 86%. So these are all very good numbers, right? You're still generally seeing upgrades, just slightly slower pace. If you look at the semiconductors, we're still sort of sitting at peak levels of upward revisions. And so we've been talking a lot to clients about this because I've talked to a lot of people who have been in the semis names, who have been in the AI theme. A fair number of people are doing well with that, but they're saying, maybe I should be looking around at other opportunities. So we look at that chart and I say, this is a risk factor, but I can't just tell you to sit here and hold your nose and sell, because if you go back and look in the past, sometimes you sit at these peak levels of upward revision for multiple years. So we have to watch how they move in time. And I know that's not a satisfactory answer. We're all supposed to have crystal balls in this business and predict what's going to happen 6 months down the road.
With certainty and conviction, Laurie.
Right. But I do think in this...
No buts.
Yeah, but I do think in this particular situation, we kind of have to take it day by day.
Laurie, it's great to have you with us. Just going to stick with us. Laurie Calvasina of RBC. Equity futures this morning down just 0.1%. Lots of news elsewhere with your top stories. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Thank you. UK Prime Minister Keir Starmer announcing his resignation. His exit opening the door for Britain's 5th Premier since 2022. Former Manchester Mayor Andy Burnham putting himself forward in the leadership race. Iran saying, quote, major progress was made in all-night talks with the US. Talks will continue in Switzerland this week with US Vice President J.D. Vance leading Washington's delegation. Chevron signing a 20-year deal with Microsoft to provide natural gas-fired power for proposed West Texas data center. The power plant is expected to be operational by 2028. Microsoft is doubling down on building data centers to compete with Alphabet and Amazon. And that is your Bloomberg brief. John.
Ivani, thank you. Thank you for the update. Up next on the programme, negotiating peace with Iran.
What today really represents is the beginning of a technical negotiation that's not going to solve every disagreement, but is going to allow us to sit together as teams for the first time really in history to figure out what matters most to the respective parties.
Just around the corner, we'll catch up with Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. check out sterling this morning. Small bounce off session lows, 132.41, just turning positive just moments ago off the back of the following news. If you're just waking up stateside, maybe not a material story to you yet, might be if things change in the bond market. But as things stand, the British Prime Minister laying out his timetable to step aside and start a leadership contest in the UK. The obvious person in the mix is Andy Burnham, former mayor of Manchester, set to become an MP, throwing his name into the ring and getting some support from Wes Streeting, the former health secretary. Maybe that opens the door to getting away from having a messy leadership contest and accelerating this process so we don't have to wait around until September. So sterling is stronger off the back of this. You'll notice that yields on gilts are a little bit lower off the back of it too. Just a little bit lower. We're down by 4 basis points or so on twos. 10's down by something like 3 basis points. As I've said repeatedly through the morning so far, consequential for the UK, inconsequential for the rest of the world unless you get a big upset in this bond market. We don't see that this morning over in the UK.
Yeah, let's see what the policies are. But as you mentioned, Wes Streeting saying and putting on X, I hope that everyone else will back Andy to at least eliminating some of the uncertainty under the hood. That said, let's see the proposals. Let's see what can actually make the UK populace feel satisfied longer than just 2 years.
What do you stand for? We'll catch up with Lizzie Burden outside number 10 Downing Street a little bit later this morning. Futures on the S&P pulling back by 1/10% on the S&P 500. On the Nasdaq up by 0.1. If you check out the bond market this morning, yields near the highs of the year stateside at the front end of the curve. 2s through 420. We're up 4 basis points this morning. Even with this move in crude, we're trading in the 70s on both WTI and Brent. Brent at 79 this morning. Under surveillance this morning, negotiating peace with Iran.
What today really represents is the beginning of a technical negotiation that's not going to solve every disagreement, but is going to allow us to sit together as teams for the first time really in history to figure out what matters most to the respective parties. Can we turn over a new leaf? Can we change relations in the Middle East permanently?
So here's the latest this morning. A framework for a lasting peace deal taking shape in Switzerland. The Iranian foreign minister saying major progress was made on Lebanon following all-night talks. Bloomberg's Tyler Kendall has the latest. Good morning, Tyler.
Hey, John, good morning. Well, this weekend marked the start of what's expected to be a protracted process for a finalized deal. We got this joint statement early this morning from mediators from Pakistan and Qatar that said the U.S. and Iran have established what they are calling a high-level committee that will essentially oversee the talks from here on out. We're then also expecting working groups to be established that will look to prioritize nuclear issues, sanctions relief for Iran, and communication regarding the Strait of Hormuz. After over the weekend, Iran said it was closing the waterway and suspending talks amid a renewed threat from President Trump to strike the country if the Iranian-backed militant group Hezbollah doesn't stop attacking Israel. A person familiar with the matter tells Bloomberg News that a resolution to the fighting in Lebanon is going to be absolutely essential towards any broader progress in these negotiations, even as Israel isn't a party to these talks. It just underscores another complicating factor in these negotiations, which also, of course, includes the long-term security in the Strait of Hormuz. John, over the weekend, President Trump told Fox News in an interview that he has directly warned Iran against imposing any sort of fees after the 60-day extension, after we've heard it floated that we could see something regarding navigational or insurance services be levied. It comes as traffic is starting to pick up, though, of course, well below pre-war levels. CENTCOM said 55 ships carrying 17 million barrels of oil transited through on Saturday.
Tyler Kendall with the latest. Tyler, we'll have more from you later on this morning. Joining us now is Colonel Wayne Sanders of Bloomberg Intelligence. Colonel, welcome to the program. Let's build on Tyler's point. This is important for financial markets. Don't track the talks, follow the barrels. How much crude is getting through the Strait right now?
Yeah, I think you're going to see this continue to uptick. So the amount of what you've seen even on Saturday will continue to go up as long as the rhetoric is going to happen. But I think what you're actually trying to look at is where the negotiations are. So as the barrels continue to push, as you're going to continue to watch, right, everybody's going to have their eyes on the amount that's actually inside of the Strait itself right now. The establishment of what they're calling the Hormuz hotline will actually help from the deconfliction. So that as these tankers start going through, you're going to be able to continue to see U.S. and Iran being able to have that conversation deconflict so that it's not something that reaches the level of what we've seen in the past.
Before this agreement, it was about 600 vessels that were stuck. Do you know what the number is now this morning?
I don't. That's the one thing that I've been trying to find out, and I can't get it based off of what CENTCOM is saying. The amount that's actually picking up is actually the really good sign here to be able to actually level out some of the pressure that's built up in this place. But I don't actually have that number at this time.
Is it fair to assume that the U.S. is just no longer enforcing sanctions on Iranian crude, given the fact that you have 6 million barrels on 3 U.S. sanctioned super tankers openly moving now through the waterways?
I think it's probably a good indicator at this point in time. I think that, especially during the 60-day negotiation, right, you're seeing a lot of leeway being given here throughout this process to be able to show some good faith as they're moving forward for this, right? You're seeing some of that in terms of the roadmap for the next 60 days, in terms of what that's actually going to look like. You actually see the Hormuz hotline, like I mentioned, as well as the Lebanon deconfliction deal, the deconfliction cell. I think all of these key pieces are really playing a part into this, to where that sanction relief is something that could potentially stay.
Colonel, it's good to see you. As always, thanks for the update. Colonel Wayne Sanders there of Bloomberg Intelligence. The talks are ongoing, of course, but is the crude moving? Yes. More of it, slowly. Energy's back in the 70s. WTI and Brent this morning.
People are watching what people do, not what they say. Right now, the saying has been all over the place. And frankly, if you listen on any given day, it's going to be different. If the barrels are actually increasing as they were over the weekend, that tells the whole story.
Laurie Calvasina of RBC is still with us. Laurie, do you get questions on this anymore from clients?
You know, I will say in my Thursday meetings, this was not the number one topic that came up, but it was probably like number 3 or 4 on the list. And it came up in the inflation discussions, right? Because what are you assuming about oil prices going forward? And it was a little bit different tact. If you look at the Fed, I think we have uncertainty rising there. I think there's still a lot of uncertainty on the Middle East conflict, but it is coming down a bit. That being said, there's still a fair amount of anxiety here. And, you know, as I was listening to the previous speaker, one of the things I sort of flashed back to was a comment that was made to me on Thursday, where one of my clients said, you know, I don't know what's going to happen, you know, with this situation. I'm not necessarily counting on, you know, all done in terms of a peace deal, but maybe we're just going to have a period of time where the oil flows and we can, you know, restore the stockpiles. So I think sort of taking kind of a very, you know, sort of tactical day by day, you know, sort of view of things and looking for reasons to be positive was something that I noticed on Thursday.
How much are people looking at the pipeline effects of delayed oil deliveries and just the sort of prolonged, protracted effects of higher oil prices working their way through the inflation data over the remainder of the year versus, say, the inflation problem being elsewhere aside from just oil?
So I'll say I may be pushing on this one a little bit more than I'm getting the inbound questions. When people ask me about market risks, one of the things I point out is that I think 2026 earnings are going to be okay. That if there's any risk to the earnings story from this situation, I think it's probably on 2027. And my reason for that is generally companies seem to be able to manage through crises for a quarter or two. And if you look back at 2018, 2019, and 2022, 2023, when we had the first tariff episode in the Russia-Ukraine war, we didn't really see any impact to 2018 and 2022 bottom-up consensus EPS estimates after those conflicts broke out. You saw a little bit of damage to the 2022 numbers in the second half of the year, but not a lot. What we did, though, see was steady decreases on 2019 and 2023 bottom-up EPS forecasts. And as I think back to everything companies have said since the war broke out, it's been, you know, we've got inventories, we've got hedges. One company said 6 to 12 months of hedges. We've seen companies refer, you know, I've seen some companies say we have a year of poly. Others have said we have a couple of quarters. So we do know those things run out eventually. And that, I think, is what, you know, but frankly, I'm pushing that more on investors than they're asking me about it.
Laurie, it's good to see you. Thank you. Laurie Calvasina there of RBC. It comes up only in conversations around inflation. And for some people, it's not the major factor in the outlook for inflation either, which I find curious. We're back in the 70s on crude, and yet we're talking about rate hikes still at this Federal Reserve.
And you can see that the two-year yield and oil prices have diverged steadily over the past trading sessions, few trading sessions. Again, how much is the inflation story hinged on oil prices, and how much is it hinged on semiconductor use, on other issues, and the strength, frankly, of earnings to continue to outperform despite some of this pressure?
Crude in the 70s, the two-year, to Lisa's point, through 420. We're higher this morning by some 4 basis points. Coming up, we'll get to that story out of the UK. Jordan Rochester of Mizuho, as Keir Starmer announces his plans to step down as the British Prime Minister. Plus, Yahira has your morning movers this morning. SpaceX shares on track for a third straight day of losses. We're down this morning by more than 5%. From New York City, you're watching Bloomberg TV. back-to-back weekly gains on the S&P 500 this morning, down by just 0.1%. You're very familiar with the bull case. This from Stuart Kaiser of Citi. Very bullish still on the outlook for equities. Forward SPX EPS up 17% since the start of the year. That's bullish. The Economic Surprise Index at a 3-year high. 3-month payroll growth near 190K. Retail sales has been decent. Anticipated equity supply, he calls it real, but we remain positive on equity markets. Can that view stand up to this in the bond market? Another call this morning, this time from Bank of America, for 75 basis points of hikes across 3 meetings starting in September from this Federal Reserve, the 2-year, near the highs of the year.
Yeah, and the framing of the Bank of America call is essentially that Jay Powell talked about risk management with 75 basis points of cuts last year. They might take that risk management off the table and might not have to cut rates again through 2027 because of the resilience of the underlying economy. Can you have your cake and eat it too, given the fact that we have an economy that is delivering these earnings, accepting these price hikes, potentially even with rates that now maybe aren't restrictive, maybe they're accommodative?
That's the front end of the story. Can we bring up the bond board again? Just look at 2s versus 10s. I know Lisa's been doing this a lot over the last week. That yield curve's been flattening. I believe this is the 4th consecutive session of yield curve flattening, 2s versus 10s. The gap between the two now is under 30 basis points. Now, the front end of the curve, very simplistic, I know, but forgive me. The front end of the curve, you're pricing in what you think the Fed might do. The longer end of the curve, you're starting to think about the consequences of that move. 2s versus 10s, that flattening we're starting to see, Bramo, notable.
Are you taking some of the growth over the longer term away from the market with a more hawkish stance at the front end? Is this a verbal intervention, given the fact that this is actually lowering the long end of the yield curve in a way that a lot of people would like to see for mortgages and for other types of loans? There's a committee for that. I'm actually very curious about the committees. I want to see what they come out with.
Committees around this table
there
for the next several months.
There are going to be 4 committees around the table of 3, and I think it's going to be really interesting. I mean, what do they come with? What data are they looking at? What does inflation mean?
It's super difficult to unpack a lot of this, given the move we're seeing in crude at the moment, back in the 70s, but we'll do our best. I want to turn to the UK. So this is the setup this morning. Sterling positive, just on the pound this morning, 132.39, up by not even 1/10%. Bit of a rally, just a small one, coming into the long end of the gilt curve. We're down about 3 or 4 basis points on 10s to 480. The sequence of things in the last, let's call it 2 hours over in the UK. The Prime Minister, Sir Keir Starmer, announcing his plans to resign, setting a timetable for some kind of leadership contest. Then we start to think about speed of the leadership contest and substance of the next leader, the policies, if you will. On the speed, Andy Burnham, former mayor of Manchester, a name that everyone's familiar with by now, incoming MP, throwing his name into the ring to become the next leader of this party and ultimately the Prime Minister. And then getting support from the former Health Secretary, Wes Streeting, maybe opening the door to a quicker process. That's good for markets. Then we can focus on policy, which might not be good for markets.
Ultimately, this is going to have to result in policy, and a lot of that's going to be who is the Chancellor of the Exchequer, right? And that's been one big question. It's not going to be Rachel Reeves. She's probably going to get booted. So who is going to come in and take the lead in trying to remedy a very difficult situation? We've already seen Liz Truss, who lasted about a month as a result of the pain that people were unwilling to take and some of the unpopular measures that she put out there in her budget. This really is where it's going to come down. The Chancellor of the Exchequer almost is more important than who the Prime Minister will end up being.
Well, maybe it's going to be Wes Streeting. He wrote an opinion piece in the Financial Times just a week ago. He said social democracy is as much about a successful market economy as it is about an active state. When Labor forgets the first part of that sentence, we and the country lose. Throwing his hat maybe in the ring.
So this is how I think the market will look at things, and we can talk to Lizzie Burden about this in just a moment. You've got Reeves less bad, Miliband bad, and maybe Streeting somewhere in between for Chancellor and what it means for gilts. Is that fair this morning?
I think that's fair, because ultimately it's been priced in that it's worse than it was before this all began, but not as bad as it was in its darkest days.
Let's talk about stocks. We'll get back to the UK in just a moment. 3 hours away from the cash open. Some morning movers with Yahara. Hey, Yahara.
Hi, John. Let's talk about the stock of the moment. SpaceX shares are falling in the pre-market. We'll get that board up in just a minute. On track for a 3rd straight session of losses. As we continue to see more analysts, there we go. It is down nearly 4.5% in the pre-market as we continue to see more analysts initiate coverage of the stock. The latest is KeyBank with a neutral rating, saying they see plenty of long-term opportunities, but in the near term, the stock could be volatile as investors continue to assess its worth and as those lockup expirations start to bring more shares into the market. Meanwhile, it can't be a Monday without some M&A news or possible M&A news, and that's why Apogee Therapeutics shares are rising more than 50% in the pre-market after a report in the FT said that AbbVie is closing in on a nearly $11 billion takeover of this biotech. It would mark AbbVie's largest acquisition in years. And we end on a big mover to the upside, and that is Getty Images soaring nearly 175% in the pre-market after it struck a multi-year partnership with OpenAI. Now it will bring Getty's library of licensed images to ChatGPT to try and create more rich, more real images. And it's an interesting turn for Getty, which was a company seen as being threatened by these AI-generated images. But if you can't beat them, join them. John?
Quite a move. That is quite a move this morning. Yahara, thank you. Appreciate it. On our radar this morning, some of our top stories. The US and Iran agreeing to a roadmap for a final peace deal, with more talks scheduled this week. Discussions hinging on a deal to keep the Strait of Hormuz open and to ensure cooperation from Israel in Lebanon. Elsewhere, China slapping export controls on 2 US producers of rare earths, blocking the company's access to certain materials on national security grounds. The decision largely symbolic, as both companies say they've cut off supplies from China. And finally, the UK Prime Minister, Keir Starmer, stepping down after 2 years in the role.
The question my party is asking now is whether I am best placed to lead us into the next general election. That is why I will resign as leader of the Labour Party.
Starmer's exit opening the door for Britain's 5th Prime Minister since 2022. The former Manchester Mayor, Andy Burnham, putting himself forward with the backing of former Health Secretary Wes Streeting. Joining us now from London, Bloomberg's Lizzie Burden. Lizzie, good morning. A lot happening already in the last few hours.
Yeah, John, I was metres away from Keir Starmer as he resigned his post as Prime Minister. As you said, it's quite remarkable that he won that landslide victory only just 2 years ago, and yet he had accepted his fate, that his party had concluded it would be better for somebody else to represent Labour at the next general election. That particularly a pronounced conclusion after the Makerfield special election, the results coming in on Friday with a resounding victory for Andy Burnham. Now, Starmer set out a timetable that looked like he would be in post for a handover in September while a leadership contest were to take place, but things could move much faster than that. As you say, some developments just in the past hour. Andy Burnham, the former Mayor of Greater Manchester, now putting himself forward as a leadership candidate. Wes Streeting, the former Health Secretary, backing Burnham, and this could therefore be a one-horse race. We wonder whether Streeting would like to be Burnham's Chancellor. Of course, he's more to the right of Burnham. It could counter some of the left-wing sentiment of Burnham. That could help in the markets. But Burnham is on his way to London now to be sworn in again as an MP. That's at 2:30 p.m. London time, so about 3 hours from now. The pound is on its way back up off these latest developments, and the chance of Burnham being the next Prime Minister has risen on Polymarket to 96% now, John.
Lizzie Burden with a very noisy report coming out of the number 10 Downing Street, just in front of number 10, following that resignation coming from the British Prime Minister. Lizzie, thank you. Appreciate it. Jordan Rochester of Mizuho writing the following: Burnham wins either way, according to polling. His policy positions are clearly to the left of Starmer, but lack detail on how they would be achieved. Jordan Rochester joins us now for more. Jordan, welcome to the programme, sir. As you know, the nervousness in UK markets was less about Sir Keir Starmer leaving. It was always about the worries about what would replace him. Jordan, what comes next?
Well, as you said, John, earlier in your previous section, it was about their Chancellor choice too. I think Burnham's positions, the market knows they're quite expensive, some of them, especially the full nationalisation. But in terms of the next step, John, it's about how soon does this contest take place? We kind of get into the details of that, and when will it finish, and how quickly could a new PM be in place? And if it is a coronation, essentially it's going to be around 3 to 4 weeks. Similar timeline to when Theresa May took over from David Cameron. If there is a longer drawn-out contest, then you're talking the sort of August period into September. And there's some commentary this morning suggesting that Andy Burnham has hasn't yet got all of his plans in place, so doesn't really want to be a prime minister within 3 weeks. He'd rather it be a little bit longer and perhaps even in through to September. So those are the timelines. But let's just imagine it's in 3 weeks. Then it's about who the cabinet choices are. And we get that within a 24 to 48-hour whirlwind of news. And as Anne-Marie suggested earlier, if Streeting has put, and he's put his name behind Andy Burnham, does that make him more likely to be Chancellor? It could be Yvette Cooper as well, Shabana Mahmood. These are other names that were being considered, as well as the sort of the dark horse, Ed Miliband, which is... Ed Miliband was once considered for Prime Minister, so he's not the end of the world for UK rates markets, but that's kind of how the commentary kind of frames it. But he is definitely to the left of most of those other candidates, so that is the one which leads to that sort of outcome, a gilt sell-off.
Jordan, what's priced in? Because ultimately it seems like there's not a lot of action on the heels of some pretty significant headlines this morning.
Well, indeed. So essentially the price action took place towards the end of last week. We had UK rates started to sell off as it started to seem quite likely after the Makerfield result, which was a very strong result for Andy Burnham. It was supposed to be a tight contest between him and Reform, and it was actually pretty gangbusters, over 20% lead. That suggests that as a leader, he could boost the Labour Party's fortunes, because that's what politics is all about. It's about getting elected. And the party is going behind that sort of Burnham momentum. That if you look back over the past few months, the writing has been on the wall for Keir Starmer. In the public opinion polls, he was deemed to be the most sort of unpopular prime minister in UK modern history. So the writing's been on the wall, which has been a matter of time. And the main reason why gilts moved last week was because of that lead that Andy Burnham had in the Makerfield. But apart from that, the bigger picture is, OK, that's the politics, but what about the data? What about the Bank of England? Where's oil prices going? And helping rates a little bit this morning is oil coming off the sort of recent levels slightly, thanks to progress being made in US-Iran talks.
Well, Jordan, to that point, how much is this story a very specific story for a political sort in the UK versus a broader macro story that suggests something bigger about bond and FX markets?
Well, the specific part is on all these policy details and how much gilts can sell off versus treasuries versus bonds. So I think going forward, if you want to take a bearish view on the UK, you need to do it as a spread versus US or Europe, because the broader picture is that yields have come down thanks to the US-Iran war ending. But the broader picture, the UK slots into actually something that's quite similar, which is fiscal spending is now potentially being entertained again. Even though the UK has been boxed in by these fiscal rules, could they be redefined? And the policy agenda that Andy Burnham has probably needs the fiscal rules to be tweaked in a way, at least on capital expenditure. So that feeds in through to the bigger picture. US is spending on the One Big Beautiful Bill. Japan's doing a consumption tax on food potentially. You've got Germany's defence spending from just the previous year, an infrastructure, feeding through to the UK thinking about public utility nationalisation, better spending on NHS healthcare, etc. So more fiscal spending, it definitely slots into a broader theme.
The head of one of Britain's biggest trade unions had said that Ed Miliband would be a, quote, noose around the neck of job creation if he became the chancellor. Could we see some sort of market reaction to the downside in the United Kingdom if we were to see Miliband become chancellor?
It's definitely the scenario that most analysts would say that leads to a gilt sell-off. And it's because of Ed's position on more fiscal spending. But he has also outlined that he would respect the fiscal rules. So I think the sort of dramatic Liz Truss moves that you've got in 2022, you're not really going to get as long as all the candidates or potential candidates for a chancellor say we'll respect the fiscal rules. So that kind of boxes them in. If they don't say that, then you do get the bigger moves. And I don't believe Ed Miliband has. So I think it's the scenario which leads to weaker performance of UK gilts. I'm not talking about a 2022 sell-off. But the other points I'm guessing from the union leader, I'd have to look at the quote exactly, is because of the views of North Sea drilling. And this is why Ed Miliband maybe is a little bit less likely, because the reindustrialisation plans that Andy Burnham has for the north of England kind of don't tie in with the net zero agenda and, of course, the North Sea drilling.
Jordan, always good to hear from you, buddy. As always, Jordan Rochester there of Mizuho on the UK. Sterling slightly stronger off the back of these developments. Gilt yield slightly lower. We're down by 4 basis points at the front end of the curve. On 10s this morning, down around 3. With an update on stories worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Iran ramping up the amount of oil it's sending through the Strait of Hormuz to the highest since the war began. According to ship tracking data, about 6 million barrels are on 3 U.S.-sanctioned supertankers that entered the choke point early Monday. Colombia electing a conservative lawyer as president. Abelardo de la Espriella is a business owner and lawyer who earned President Donald Trump's endorsement despite never having run for office. Microsoft CEO Satya Nadella is joining an effort to take on AI giants. Speaking to the Wall Street Journal, Nadella criticized the state of the AI race and said Microsoft is rolling out low-cost models and considering hosting an ultra-low-cost AI provider in an effort to drive prices down. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, committing to 2%.
What we got out of Warsh in hindsight was not a surprise given his inflation hawkish background.
He pretty much committed to 2%.
We're going to have more uncertainty about what the Federal Reserve is going to do.
Up next, we'll try and get you some clarity. Krishna Guha of Evercore from New York City. You're watching Bloomberg TV. Stocks slightly negative. We're down just 0.1% on the S&P. The Nasdaq just about unchanged. Some movement in the bond market. 2s, 10s, 30s. Yields starting to drift just a little bit higher to kick off the trading week. Up by 4 on 2s, up by 3 on 10s. Just short of 450 again on a 10-year. Under surveillance this morning, committing to 2%.
What we got out of Warsh in hindsight was not a surprise given his inflation hawkish background.
The FOMC has to be particularly attentive to its mandate around price stability.
He pretty much committed to 2%.
We're going to have more uncertainty about what the Federal Reserve is going to do.
So here's the latest this morning. Fresh data from the Federal Reserve's preferred inflation gauge due out later this week as the Fed chair, Kevin Warsh, reaffirms the central bank's commitment to price stability. Krishna Guha of Evercore writing lower headline inflation from oil is only half of the progress we think needs to come through to prevent a Fed hike in September. Krishna joins us now for more. Krishna, welcome to the programme. I'm pleased you're picking up on this point. I'm interested by it. How dependent is this rate hike debate on what happens with energy and the Strait of Hormuz?
Well, I think it's almost a necessary condition right now to avoid a rate hike that the peace deal gets properly bedded in and oil continues to track lower rather than moving back up again. You know, there's a lot more to oil weighing on the U.S. inflation outlook. We still have to make sure that the tariffs roll off. We've got to be very careful tracking this wave of cost spillovers from AI capex. And of course, we've also got to confirm that the underlying inflation rate is tracking down towards 2%. You need more than oil, but I think you need oil for sure.
And we need a Fed chair to outline what he actually thinks about the incoming data. And Krishna, we've not had that. I watched the news conference last week. I watched Lisa speak to a series of guests following the news conference, and I stepped back and thought, are we confusing a lack of guidance for a hawkish shift? Are we confusing one with the other, Krishna?
So I certainly accept your point, which is that Kevin Warsh was very, very forceful on the Fed's commitment to its price stability mandate, and then refused to give us any operational understanding of what that means. No discussion, even really in any detail of the current data, no discussion of the strategy, no discussion of what we call the reaction function. So it's possible that we may have misunderstood him, but I think in a sense that might be overcomplicating things. At the end of the day, Kevin Warsh made a very strong commitment on inflation, period. He then declined to give us any nuanced, flexible, thoughtful sort of discussion about policy strategy, about how patient one might be to see if the data is moving the right way. I think he's set himself up, deliberately or otherwise, in a situation where he's put a stake in the ground on inflation. And if inflation doesn't start moving his way pretty soon, he's going to have to hike, period, or lose his credibility.
Krishna, one thing he also said was that markets need to be a pure input into the Fed's reaction function, and that he wants the markets responding to the data themselves, not the expectation of what the Fed will do with that data. Is the market giving them a green light right now to hike rates at least once, if not twice, this year?
So I think there's two things there. First of all, I very much agree with you that Warsh wants the markets to form independent views of the economy and then derive rate views from that. I think that's a worthy aspiration. I just question whether that's really what happened over the last week or so, or whether the market instead looked at Warsh, looked at the dot plot and said, the Fed's more hawkish than we thought. We better price in sooner hikes. But certainly, the fact the market is now discounting a hike by September does, I think, to some degree at least, give Walsh a pass to move down that path. I would just caution, though, that I think there is a difference between the rates market discounting a Fed hike by a certain date a few months in the future and the Fed actually hiking rates today. I still think the stock market, for instance, would respond if the Fed moves ahead with a rate hike by September.
That's what I was going to ask you next, Krishna. Has the stock market accepted the rate call that the bond market is pricing in? And it seems like the answer to that is not at all. Is that correct?
It's not clear the market has really fully discounted the Fed going. And then what I would also just add is if Walsh is going to go ahead, I think he'll need to revisit this very sweeping refusal to provide any context and commentary at all. Fine to stay away from forward guidance, but I think if he goes, it'll really matter if he's able to characterize that in the context of a strategy. Is that something that is, in effect, what Powell might have called the beginning of a limited mid-cycle adjustment? Is it the start of a full cycle of Fed rate hikes? Is it one and done, which the ECB's toyed with at times? I think we're going to find that we do need in the Fed's own interest, some color around their thinking.
Krishna, as Jonathan has made this point a number of times, if Kevin Warsh is unwilling to give forward guidance in terms of his communication, does he just end up outsourcing it to other people and then do speeches like the one we're going to hear from today when it comes to Christopher Waller matter that much more?
Yeah, that's absolutely the problem that Kevin Warsh will face. And of course, we saw it in miniature already at the meeting itself, because Kevin Warsh took all the guidance out of the statement that he substantially controls, but of course was still left with the dots, and so the dots took on additional importance. Similarly, if he won't talk, not just about forward guidance, we really shouldn't confuse forward guidance with a discussion of the economy, what the Fed's looking at, what its strategy is, what its reaction function is. If he's not willing to do any of that, then that gap will be filled by other Fed officials. Now, I think they may respect Warsh's call not to provide specific guidance on their near-term rate intentions, but otherwise they will discuss the monetary policy strategy, as they should, and we will follow them if Warsh won't speak himself.
Krishna, it's good to see you. Fantastic breakdown. As always, Krishna Guha there of Evercore. Credit to Annmarie, who came out very early and said, I don't expect a dot from the incoming Fed chair, Kevin Warsh. We didn't get one. To Krishna's point, because we didn't get one, we put even more weight on the dots we did get. Governor Waller speaking later this morning around 9 a.m. Eastern time. You put even more weight on what he might say on the future for Fed policy.
Yeah, and when you get New York Fed President John Williams speaking on Thursday, and then, then later in the week, we've got Neil Kashkari, how much are these people going to suck up the oxygen, given the fact that otherwise we have committees? Are they on the committees? What do they feel about this? How do they feel about it? And do they feel like they've got to take action? Because ultimately, it is a committee.
Kashkari and Goolsbee later this week, I believe. Yeah, they've got their own thoughts on things. They often do. They
often tend to be a little bit in a hawkish direction, at least of late. So how much are they going to come push back against the way of communication, saying it is important that we communicate? I mean, really, it'll be interesting. But to your point, he didn't dot, and that's a big deal.
He didn't dot. This, for the record, this was first reported in the Financial Times. A lot of individuals were speculating on this. And then it does mean that the other dots carry more weight. And then to your point, you just outsource potentially the direction of travel to other people in the committee. I don't see a lot of Fed officials basically trying to restrain themselves, especially after what we've seen from Steve Myron and now a new robust rhetoric coming out of Fed officials because they feel like they have this space to speak.
We've got to track a few things this morning, including developments in the UK and this. We could hear from the Vice President in a few moments. The Vice President, J.D. Vance, speaking at Switzerland, could be in about 4 minutes' time. Up next on the programme, we'll also catch up with Jim Reed of Deutsche Bank, General Karen Gibson of Economies Securities, the Republican Senator Dave McCormick, and Nouriah Roubini of Hudson Bay Capital.
It may be a do-nothing Fed for a while.
There's not an emergency state in the labor market.
The markets are leaning incrementally hawkish.
We need to be raising rates to rein this in.
With the environment that we're seeing around rates, that only provides a tailwind.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Pulling back on the S&P by just 0.1%, following 2 weeks of gains on the S&P 500. On the Nasdaq this morning, positive by not even a tenth. In the bond market, yields higher across the curve. 2s, 10s and 30s. 2s up by 4, 10s up by 3. Heading into this week right here, which includes PCE data later this week. The Fed's preferred inflation gauge, at least for now.
And this Fed has a 2% target for inflation. They want to get back down to it. They think it's unacceptable under Kevin Warsh that we have been above that 2% target for more than 5 years. And that reasserted desire to get back to 2 has gotten a lot of people talking about rate hikes. Question is, A, do you get rate hikes without some sort of follow-on from oil prices going higher? They are going lower. And number 2, is this all talk, as you've pointed out, or is this actually going to come through in action? The bond market seems to be pricing in that it is going to be action. Stock market, maybe not so much.
Two key figures speaking this week. Governor Waller later this morning. President Williams, over at the New York Fed later this week. Are they going to support where markets are pricing rates right now, which increasingly is for rate hikes, supported by a call from Deutsche Bank? We'll get into that in just a moment. Supported by another call from Bank of America earlier this morning.
If they do, how much further does the market go, or does it just turn into suddenly a stock market story as the stock market wakes up to the likelihood that there will be Fed rate hikes? Ultimately, it is a committee, and we've talked about this. You've mentioned it, you and Annmarie both, about how if there isn't guidance coming from the top, it'll come from all corners. Will the market now look to Governor Waller as sort of the lodestar of this particular committee?
It's funny how independent this conversation is of developments taking place in crude right now. Krishna Guha was talking about it over at Evercore. It's part of the story, not a major part. Crude back in the 70s, not just WTI, Brent as well. Brent crude this morning at 79, WTI around 75. In the next few moments, maybe the next few minutes, we could hear from the Vice President, J.D. Vance, out of Switzerland.
Out of Switzerland, giving us an update on his talks with the Iranians as well as the Qataris and Pakistanis. The Iranian leadership that's leading the delegation left. We do know technical talks will continue for the next 60 days as we basically have this interim peace deal. The fact of the matter is, what matters to Wall Street and why you see oil prices coming down is CENTCOM on Saturday talked about 55 merchant vessels carrying cargo, 17 million barrels of oil. And then this is really important. Iran is ramping up what they're willing to get out of the Strait of Hormuz right now. And they have 6 million barrels right now on 3 U.S. sanctioned supertankers. Doesn't seem like the United States is going to be enforcing those sanctions, and they're willing to see a lot more crude hit the market.
Tracking the politics for you throughout this morning, not just over in Switzerland, but also out of the UK. Earlier on, about 4 hours ago, we heard from the British Prime Minister suggesting that he'll be resigning, indicating he'll be resigning, planning to step down, offering us a timeline. And then we heard from Andy Burnham, the former mayor of Manchester, incoming MP, throwing his name into the ring to be the next leader, supported by the former House Secretary, Wes Streeting. So Starmer quits. Looks like Burnham's coming in. On what timeline? Maybe before September, perhaps as soon as August, I don't know. But the market's pricing in this being resolved pretty quickly. So you get sterling a little bit stronger. You get gilt yields just a little bit lower. And then we can spend the summer really focusing on what we need to focus on, which is policy in the UK.
How much are they going to raise taxes? Can they expand benefits given where the deficit is and given the pushback that you've seen in the pound in the past? Will he pull a Liz Truss that we saw back in 2022 that caused her to leave 1 month later? Is he going to be able to deliver some sort of agenda that can provide stability to a nation that has been in turmoil, frankly, going back to before the pandemic?
We've been managing the pace of deterioration in the UK for much of the last 10 years. Equity futures right now on the S&P stateside, just negative by 0.1%. Lisa mentioned it later this week. It's not just about PCE, also about Micron. And maybe for equity markets at the moment, that's the big story this week. It's the earnings from Micron, not the data on the inflation side.
Yeah, how much can they increase given how much the shares have already rallied? Is the semiconductor one a story one that can continue in perpetuity even as you get a number of different hyperscalers pushing back, creating their own chips, starting to talk about being a little bit more selective in how they deliver their tokens?
Micron coming up a little bit later this week. That stock is positive in the pre-market. Coming up this hour, we'll catch up with Jim Reid of Deutsche Bank on the hawkish path ahead for the new Fed chair, Kevin Warsh. General Karen Gibson of Economies Securities warning of future security concerns as the two sides work towards ending the war. And the Republican Senator Dave McCormick with President Donald Trump facing some serious pushback from his own political party. We begin this hour with stocks stalling to kick off a key week of economic data headlined by PCE on Thursday. Following Kevin Warsh's debut as Fed chair, the team at Deutsche Bank adjusting their rate cut expectations, now calling for 2 hikes this year. Jim Reid of Deutsche Bank writing the following: even as inflation expectations fell, the Fed's latest decision inflation led to a clear hawkish repricing for markets. The central scenario sees 2 rate increases this year, likely in September and December. I'm pleased to say that Jim joins us now for more. Jim, welcome to the programme, buddy. Always good to catch up. Let's get to the shift, the move towards rate hikes, Jim, and what underpins that move for you and the team?
Yeah, look, I think for several months now, it's clear to us that if you were looking at the US economy from scratch, I had no bias beforehand, then a rate hike was much more likely than a rate cut. I suppose the thing that prevented people necessarily predicting that or seeing it is the institutional bias and the kind of view on the committee that we're in an easing policy bias. But I think the raw data has kind of looked more in line with a hike than a cut for some time now.
So, Jim, we're tracking these talks in Switzerland. We're hearing from the Vice President, J.D. Vance, right now. I can offer you some of the headlines that we're getting so far from the Vice President. The talks with Iran were very good. We've made a lot of good progress. We've set up a mechanism for keeping Hormuz open. Iran has agreed to invite inspectors for nuclear. This is all very promising stuff, Jim. And with that, you've got crude into the 70s. But, Jim, what is curious about this morning, and for that matter the last week or so, is that crude has pulled back, and yet rate hike expectations have firmed up. Jim, the question we've been asking around this table is how dependent these events are in Switzerland, that events are in Washington at the Federal Reserve, on the events that take place in Switzerland.
Look, I think if you look at some of the measures we look at, like the output gap of the US, it's been positive before the war anyway. And if you look at inflation, most of the drivers of inflation in the last few quarters, few years really have been more demand side than they have been supply side. So I think there is this narrative in the market that a lot of the US inflation has been supply shocks. But for us, it is a hot economy in terms of demand, and therefore it makes sense to shift to a tighter hike in bias, I think.
Right now, we're seeing stock markets fluctuate, but not really responding to this idea that there could be potentially rate hikes, not really responding to any kind of resolution in Iran either. Do you think that bonds and stocks are operating in totally different regimes right now, at least in the United States, with bond markets looking at the underlying inflation, underlying economy, and stock markets looking at Micron and how much their earnings can increase?
Yeah, look, rate hikes and rising yields don't automatically have to mean weaker equities, because if the reason for rate hikes and higher yields are reasonable growth expectations and reasonable earning expectations, then you can have higher yields and higher equities at the same time. So I don't think we need to read too much into that. I suppose where the problems will arise is if you have higher rate expectations and people having doubts about the growth expectations as a result of it and earnings. So that would be the real nightmare. But at the moment, that's not the case.
Jim, bit of news to share. Some sad news. Jim, it comes from the late Alan Greenspan, now late Alan Greenspan. According to his wife, the influential economist who served as Federal Reserve chairman under 4 presidents has died at 100. That reporting coming from NBC News this morning. Jim, the timing of this, of course, will start a conversation about the kind of Federal Reserve, the institution that he led, the lessons maybe that Kevin Warsh took from that. Jim, can you just reflect on that era of the Federal Reserve and maybe how instructive it might be for the future of this institution under Kevin Warsh?
Yeah, that's very sad news. Obviously, throughout my career, Greenspan has been an ever-present kind of doyen of the Fed, etc. So that's incredibly sad news. I think in terms of the Fed, there is a battle on how much forward guidance one needs to offer the market. Obviously, Warsh has taken a different view to previous chairmen, and I don't think one is right or wrong. It's just situational. There was a period in the 1980s when obviously Greenspan took over, where I think because of the inflation in the 60s and 70s, it was good for the Fed to lay their kind of credentials on the table and kind of give that forward guidance, give the market certainty, get credibility. So I think the forward guidance era of the time and of Greenspan's era, et cetera, was a very rational policy move to give markets what they were looking for at the time. I think we may be in a period now where it is more difficult to give that forward guidance. There's a lot more uncertainty. So maybe Walsh is responding to that, and it could be completely credible in the same way that it was credible 30 or 40 years ago to give more forward guidance, if that makes sense.
Jim, do you think that the current Fed chair is going to be more in line and wants to show himself more in line with the Paul Volcker and to some degree Alan Greenspan Fed, which ended up hiking rates in 2000, which some people say led to the dot-com bust, versus, say, an Arthur Burns? How much is he trying to rebut the concept of that Fed and harken back to the Alan Greenspan era?
Yeah, look, I think Walsh has obviously always been someone who sees inflation as a key part of the mandate, and I think he reiterated that last Friday. I mean, he couldn't have been clearer that it's not acceptable that inflation has been above target for as long as it has been. Obviously, he is not the sole vote on the committee. There are a wider committee, and he doesn't have the ability to completely drive it. But I think data will drive it, and I think we're seeing that shift in the committee now, where more and more dots are leaning towards a rate hike. And look, committees take time to kind of move. They don't move on a dime usually. They tend to take time. And I think we should see the evolution of this committee moving now into a more hawkish direction because of the data that they can see in front of them.
Given that, Jim, how much is there going to be a reversal of some of the expectations of dollar weakness later this year because of the hot economy and a Federal Reserve that seems squarely trained in the Alan Greenspan frame of mind to potentially hike rates in the face of strength?
Yeah, look, I think the dollar has a few different conflicting drivers. I think, interestingly, probably 18 months ago, I think the whole world wanted to be long US dollars and US assets. And while I think the US is still a place where most international investors want to be long and exposed to, definitely get the feeling that they probably don't want to be quite as long and exposed as they were. So when you probably do get a bit of dollar strength, there is a desire to kind of lighten that exposure, etc. So yes, if the Fed is moving into a more hawkish picture, it does probably underpin the dollar, but there are kind of global forces around that are probably leaning in the opposite direction. So I think probably dollar strength is probably one to be leaned into a little bit.
Hey, Jim, always got to catch up, and thanks for handling that breaking news with such grace. Jim Reid there of Deutsche Bank. Following this news from NBC that the former Fed chair Alan Greenspan has died at age 100. Many of you in this market very familiar with this quote. If I seem unduly clear to you, you must have misunderstood what I said.
This is someone who didn't really want to be all that clear and operated through a tenure from 1987 to 2006, was nominated for an unprecedented fifth term as Fed chair by then President Bush. A real question of how he maneuvered through the market crash of 1987, as well as the dot-com bust in 2000, and potentially setting a template for those who come afterwards.
A lack of guidance and centralized power. Centralised power is the conversation we'll have increasingly in the coming months and year under this incoming Fed chair, Kevin Walsh, new Fed chair, particularly at a time where he doesn't want to offer guidance. Is he able to centralise power when so many other officials on this committee right now are so outspoken on where they think policy should be, not just now, but in the future?
Can you put the genie back in the bottle? Right now, the market's responding to the dots. Even if he didn't put a dot down, people are responding to the 9 Fed officials who did. And ultimately, this is a market still responding to their expectation of what the Fed will do, not necessarily incoming data that's anything new.
We got a lot of news this morning. Let's get you up to date on things with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Yep, just some of the details that we got about the former Fed chair, Alan Greenspan. He has died. NBC News reporting Greenspan's wife of 29 years, Andrea Mitchell, confirmed his death at age 100. Greenspan served 5 terms as chairman of the Fed under 4 presidents. UK Prime Minister Keir Starmer announcing his resignation after 2 years in the role. Starmer's exit clearing the way for former Manchester Mayor and incoming MP Andy Burnham to try to become Britain's 7th Prime Minister in a decade. Vice President J.D. Vance saying yesterday's talks with Iran were good and that negotiators made a lot of progress. One of the main goals of negotiations was to keep the Strait of Hormuz open. Vance saying that discussions with nuclear inspectors could happen today. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much for the update. Up next on the programme, back at the negotiating table, Vice President J.D. Vance providing an update on talks between the US and Iran. Those comments happening right now. We'll get reaction from General Karen Gibson of Economies Securities. She joins us next. Live from New York City this morning. Good morning. Here's the state of things this morning, pulling back just by 0.1% on the S&P 500. For a moment, things were firming up. Constructive tone coming out of Switzerland. Some comments from the Vice President moments ago. We'll get to those comments in just a moment. On the Nasdaq, we're just about positive. In the bond market, reflecting on a new Federal Reserve with yields higher, but also thinking about an old Federal Reserve under the leadership of Alan Greenspan. According to NBC, citing a statement from his wife this morning, Alan Greenspan, the former Fed chair, has died at 100.
After serving as Fed chair from 1987 to 2006, became synonymous with the Greenspan put, where, yes, he would have a firmer hand when it really came to cracking down on inflation, but ultimately would rescue assets should they fall enough. That's the belief that was baked into markets, really having us reflect on what the form of Kevin Warsh's Fed is going to look like, given his first press conference left a lot of questions, a lot of committees working through the night, and the market expecting rate hikes.
Very vague, and a lot of people filling in the gaps under the new Fed chair. Let's turn to crude in the 70s on WTI and Brent this morning. We're down across the board, 79 on Brent, 75 on WTI. Under surveillance this morning, back at the negotiating table. Here's the latest this morning. The Vice President J.D. Vance providing an update on talks between the US and Iran. Vance saying he will return to Washington while teams continue to work during the week. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, we just heard from the vice president saying that essentially the goal of this weekend was to lay the foundation for finalized talks to begin later this week. He said that good progress was made, but added, quote, there is still a lot to do. He said the goal of this weekend was to establish four main things. One, outline this process for the broader talks. Two, establish what is being called the deconfliction cell, which will extend the ceasefire to Lebanon. He did confirm that Iran threatened to walk out of the talks after President Trump said that he would strike the country if Hezbollah didn't stop attacking Israel. Three, he said Iran has agreed to invite inspectors back into the country, he says, as soon as this week, potentially. And four, a mechanism to keep the Strait of Hormuz opened. Of course, the levels are still below the pre-war highs, but we did hear from CENTCOM over the weekend confirming that 55 tankers carrying 17 million barrels of oil transited through on Saturday. And new this morning from Bloomberg News, we got this data showing that 4 empty LNG tankers linked to Qatar are starting their transit through the strait, marking the highest number that we've seen of empty LNG tankers trying to return back so that these Middle East exporters can restart again. And then, John, I'll throw one more thing on your radar from the Vice President J.D. Vance, saying that if Iranian assets are unfrozen, then the money would be used to buy American agricultural products, seeming to allude to the fact that maybe we could get some sort of deal here, though he declined to give specifics or how this would really work in practice.
Tyler Kendall on the ground in the nation's capital. Tyler, thank you. To build on that, General Karen Gibson of Economies Securities writing, the global and domestic economy should benefit from the resumption of commerce in the Gulf, but the future security situation remains uncertain. General Gibson joins us now for more. General, welcome to the programme. In the short term, and I stress in the short term, this market doesn't really care about the contours of the detail or the details of a deal or an MOU. They just want to see the energy moving through the Strait of Hormuz, and the energy is starting to move. Not back to levels we've seen previously, but it's starting to move. That's the short term. In the longer term, General, what are you focused on? And what are the flaws in that thinking?
Yeah, so I agree. In the short term, these are really positive signals, not just the movement of ships through the strait over the weekend and the higher number that we're seeing, but also these early indications from Switzerland now that those talks have actually begun. But I think we've baked into the text of the MOU some key challenges. Specifically, before the text was published, we looked at some of the challenges in terms of interpretation, implementation, verification, and enforcement, and key spoilers, the biggest one being the conflict between Israel and Lebanon. And that's what's baked into actually the first paragraph of the MOU, where potentially this previously intransigent conflict between Lebanese Hezbollah and the nation of Israel could hold hostage an ability to continue having discussions with Iran anytime it heats up. I think now we are relying on the conduct of two non-signatories of the MOU, again, Israel and Hezbollah, and the way that they respond to one another's provocations, and that could hold hostage the entire deal potentially.
Well, so far, what is Israel's stance on this MOU?
Israel is not happy about the MOU. First, I think there was a disappointment that it didn't address things like missiles, drones, and proxies, all of which they live within range of, and we do not. And then certainly this piece about Lebanon is a key challenge for Israel. You know, Hezbollah represents both a political party but also a militant terrorist wing. That militant terrorist wing is committed in its manifesto to the destruction of Israel. And they reside immediately across Israel's northern border. There are Israeli troops currently deployed, occupying terrain in Lebanon. That's not something that Hezbollah is going to stand for. I think it's a very tricky situation, and as you point out, not one that Israel is happy about.
Given the market is really focused on the movement of energy right now, are we ever going back to Iran using the Strait of Hormuz as this leverage, given the fact that over the weekend the president said the U.S. would act as a, quote, guardian angel of the strait?
Yeah, so I think, you know, we can't change the geography. And Iran has demonstrated tremendous leverage it has and an ability to choke things off. I think there are a couple of future scenarios, one in which, you know, we bring some potentially lasting peace to this issue between Lebanon and Israel, where we unlock the straits and it contributes to economic prosperity in the region. But there's another potential future in which an emboldened Iran, now led by perhaps a more hardened and powerful Islamic or IRGC, the Iranian Revolutionary Guard Corps, has a potential to or perceived leverage that could cause some of our Gulf partners to cut side deals with them and really start to erode in some ways the broader security umbrella that we've had in the Gulf region with those partners. It's a perception of leverage that is just as important as their actual actions, if that makes sense.
General, can you have negotiations between two parties that have no trust for each other?
Well, you can, but it's certainly going to be far more difficult. I think this is where the Qataris and the Pakistanis play a critical role. We are fortunate that there are entities like Pakistan and Qatar that are trusted by both sides. There aren't a lot of entities like that. And so their role will be very important going forward.
General Karen Gibson of Academy Securities. General, thank you. Appreciate your time, as always. Frozen assets. And unfreezing said frozen assets. That's the controversial point in all of this.
Yeah, and a lot of it is actually kind of obscure on purpose. The details still need to be worked out. Will the United States unfreeze those assets? How quickly will those assets be unfrozen? To the vice president's point, will they really go to the Iranian people? We saw this under the Obama and the Biden administration. They were supposed to be used for humanitarian purposes. And then when it comes to this $300 billion fund, who's going to be funding that? Is that really these GCC countries that just got hit pretty aggressively by the regime?
A constructive tone coming from the Vice President out of Switzerland this morning. We'll get the Republican view in just a moment. We'll catch up with Senator Dave McCormick as President Donald Trump faces pushback from his own political party. Plus, Yahira has your morning movers. Another check on SpaceX coming back down to earth slightly. We're down by close to 6% in the pre-market. From New York City, you're watching Bloomberg TV. Back-to-back weekly gains on the S&P 500 this morning, pulling back by just 0.1%, slightly lower after a really strong finish to the week just last week. On the Nasdaq, slightly firmer by 0.1%. Switch to the board and turn to the bond market. Let's talk about the yield curve. 2s, 10s and 30s. Two-year yields at the highs of the year up 4 basis points on a session. 421.72. You'll just notice the 10-year yield move lags that up by just 3 basis points, just short of 450. 2s versus 10s. We've seen some flattening of this yield curve over the last 4 sessions against the backdrop of much lower crude prices, so difficult to unpack that, but let's give it a go. On 2s at the moment, pricing in the possibility of rate hikes. On 10s, maybe the consequences of that. 2s, 10s, and that delicate dance right now, implying something.
This is a Fed that seems to have indicated, at least based on market expectations, that it is more hawkish, ready to hike rates potentially. We're seeing rate hike calls now from Deutsche Bank and Bank of America, as you've mentioned. Is that taking away growth from the long end? And ultimately, that seems to be what people are pricing in on the margins. Or is it controlling the long end that might have been getting a little unmoored earlier in the year?
That's the US bond market. Let's turn to the British bond market. Gilts and sterling firming up just a bit earlier on this morning. Sterling at 132.38, unchanged on the session. Yields are lower by just 2-3 basis points, 482. If you looked at that board, you wouldn't have a clue what was happening in the UK this morning. So Keir Starmer announcing his resignation, set to be replaced by incoming MP and former Mayor of Manchester, Andy Burnham. Now, I say set to be replaced because there's meant to be a leadership competition, but it's looking like a coronation at the moment, given the former House Secretary, Wes Streeting, is offering him his backing.
I'm surprised that this isn't moving markets more. Yes, it was all priced in at the end of last week, but we have no idea what the policies are. This is going to be the 5th prime minister in the past 4 years. It just raises this issue. What's the market paying attention to right now? In this country, maybe not the elections, maybe it's the details, and frankly, it's the oil market and some of the macroeconomics that seem to be imposing themselves on nations around the world.
We'll have more on that story for you later this morning as we count you down to the cash open, 2 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. SpaceX losses are mounting. Shares are down 5% in the pre-market, on track for a 3rd straight session of losses. And this is coming as more analysts start to initiate coverage on the stock. The latest is KeyBank with a neutral rating, saying that they see plenty of long-term growth opportunities, but in the near term, the stock could be volatile because investors are continuing to assess its worth. Plus, you have this idea that lockup expirations could add more shares to the market. Moving on to the chip sector, that is up this morning. We are seeing Intel still riding high, up 3% after President Trump's comments that it will be working with Apple on chip manufacturing and chip design, though Intel itself has not confirmed those reports. We are also seeing the memory names like Micron and Western Digital up, just ahead of Micron reporting earnings on Wednesday. And we end on Robinhood. Moments ago, it announced it is raising $2 billion through a convertible debt offering. And as is often the case with these deals, investors are weighing the possibility that those notes could eventually turn into stock. So we are seeing shares down 2.25% in the pre-market. And this comes just a week after Robinhood announced it is cutting 10% of its workforce. John?
Yahara, thank you. Thank you for the update. More from Yahara in the next hour. On our radar this morning, the Vice President, J.D. Vance, touting successful talks with Iran.
Yesterday was a very, very good day. We made a lot of good progress. We did exactly what we wanted to do. We wanted to build a mechanism for keeping the Strait of Hormuz open. It is open. The Iranians have agreed to invite IAEA inspectors back into their country. That is a major milestone for the American people.
Vance saying talks with nuclear inspectors could happen as soon as today. Vance adding the US has been in constant contact with Israel. Elsewhere, the British Prime Minister, Sir Keir Starmer, announcing his resignation.
I will remain in post as Prime Minister until the contest is complete. And I will do everything I can to ensure an orderly handover of power. I will also give my successor my full and unequivocal support.
Starmer's departure paving the way for Andy Burnham to potentially become the 7th Prime Minister in the last decade. And finally, the former Federal Reserve Chairman Alan Greenspan has died at the age of 100, according to NBC News. Greenspan served 5 terms as chairman of the Federal Reserve under 4 presidents, the tenure the second longest for a Fed chief.
It comes at a rather poetic time. It is the exit of the second longest serving Fed chair as we bring in a new Fed chair, Kevin Warsh, with a different approach to the Federal Reserve. You've been talking about how the Greenspan Fed was one that didn't give a lot of signaling, didn't give a lot of forward guidance. Is that going to be the same kind of lodestar for this new Federal Reserve?
And we've heard the Treasury Secretary talk about this in the lead up to them naming Kevin Warsh. Earlier this year, he talked about how the Fed needs to have an open mind, like the, quote, open mind maestro. Former Fed Chairman Alan Greenspan resisted premature rate hike pressure and the likes. That's the Federal Reserve this administration would like to see as we talk about and think about the late Alan Greenspan this morning.
Under the late Alan Greenspan, we centralised power behind one voice. Are we going to do that again this time around? It doesn't feel like it. It feels like that would be difficult for Kevin Walsh to do that, if that's something he's attempting to do.
It's one thing to set a precedent. It's another thing to put the cats back in the bag. And the cats are out, and they're going to be talking this week, so let's hear what they have to say.
They're going to be fighting, I imagine. We'll hear from Governor Waller later this morning. Not much of a fighter, although he's strong enough to be a fighter if he wanted to be.
Oh, yeah.
See those deadlifts?
It's ridiculous.
Phenomenal.
I mean,
that kind of gym's ridiculous. Puts us all to shame. Let's turn back to the Middle East. Negotiators for Tehran and Washington continue building the roadmap for reaching a final deal. The president facing some pushback from his own party.
History demonstrates that giving billions of dollars to theocratic lunatics who want to murder us is an exceptionally bad idea. And I think, unfortunately, the president is receiving some really bad advice on this deal.
The Republican Senator Dave McCormick joins us now for more. Senator, good morning. Good to see you, sir. How are you? We're still in the negotiating phase, so it's difficult to judge a deal that we haven't got yet. Yeah. What are your thoughts, your assessment of the process and how this is coming together?
Well, let me start by just a word on Alan Greenspan, who I know his wife, Andrea Mitchell, well. So today we celebrate a great life. And I introduced Kevin Walsh at his hearing, and Kevin is a big admirer of Alan's as well. And it'll be a different challenge, but we have the right man for the job. He's going to help lead the Fed, I think, in a time of great change and uncertainty. With regard to the Middle East, I think you have to start with the beginning of this, is that President Trump took a series of actions which puts us in a position for a set of negotiations. So enormous progress, taking the nuclear program way back, reducing their missile capability, their launchers. So Iran is in economic difficult straits, and militarily has been dramatically affected. Now, as we think about this MOU, there's three things that have to be achieved through this 60-day negotiation, which I think are critical. And the president has more or less said this. Number one, the strait has to be open and unhindered by Iran. There can be no control. Second, they have to give up their enriched uranium, and there has to be a path to no nuclear program. We may have a step forward on this with the nuclear inspectors. And the third thing is, it needs to be pay for performance. In other words, each step along the way in terms of sanction relief has to be only coming when there's actual movement on the part of the Iranians. I think it's too early to tell whether that's happening or not, and we'll see as these negotiations proceed. But the president's goals were clear from the beginning, and I think that's what we have to stay true to.
But there are two of president's goals that are not being addressed in this MOU, and that's the ballistic missile program, and that's the money to Iranian proxies. Do you expect the president to somewhere address these red lines that he has had for years, since going back to his first term?
Well, the first one we've made a lot of progress on. So, I mean, the missile attacks that we've done on, and the air attacks we've done on their missile program, on their drones, on their manufacturing capacity, on their launchers, have been extraordinarily successful. So their capability is a fraction of what it was. How far along we are, I think, remains to be seen. But there's been big progress. The second issue is whether they're going to actually stop the funding for Hezbollah and others. We've also made huge progress in taking down Hezbollah and Hamas. If we move forward on this path, we'll see whether there can be a future commitment on financing of the terrorist groups. Right now, I think the focus is on the nuclear program.
What role do you see Congress playing in all of this, especially when it comes to the sanctions relief that the MOU addresses for the regime?
Well, it depends. It depends what the agreement turns out to be. But I expect Congress will have a role. And for this to be lasting and meaningful, Congresses need to be involved and hopefully have something that we can approve leading into the next administration. I think part of the reason the Obama deal was ineffectual was that it was never a signed deal and was never passed by Congress.
I want to go back to Alan Greenspan for a minute, because this is a really pivotal moment, given that we're ushering in a Kevin Walsh era that potentially is going to be very different from what we've seen. Given where inflation is currently in Pennsylvania, given what you're seeing in markets, do you think it's appropriate to be hiking rates at this point? Do you think that this is something that even the president would welcome?
Well, I think Kevin was wise in a couple things. You have two big forces coming at the economy at the same time. You have what's happening in the Middle East. You have the oil shock and how that's affecting pricing, particularly in energy pricing, but it's affecting everything. We've seen a lot of relief on that recently, which is a huge deal for Pennsylvania's working families. Gas under $4 makes a big difference. I was just in Pennsylvania for 3 days. They talked about it. The second thing is this enormous capital investment in AI and infrastructure, which can have a significant deflationary impact and a huge increase in productivity. So I think it's going to take a while to sort that through, and I think Kevin's being very wise, and the Fed, I think, will wait until it has a little more insight into which way things are headed. You made the point about a single voice. I think Kevin will be an incredibly articulate voice, but he talked in his hearing about family fights and the idea that there's going to be a real open exchange at the table with conflicting views on the table. He's got some very strong views on the data and the data models and how they need to be updated. So I think it's going to be a different Fed than under Alan Greenspan, but one more suited for the moment.
Is the narrative that AI is disinflationary, does that work with voters? It might not be working with markets right now, but does it work with voters who are saying
listen, with AI, the challenge, and I see this every day, is there's an enormous amount of misinformation. And make no mistake, the Chinese are behind a lot of that. Look at the hearings that are being conducted in the House and the Senate. There's been a lot of reporting on this. AI and data centers in China have an 85% popularity. In America, they have about a 20%. A lot of that's based on misinformation. So one of the responsibilities I think we have in the public realm is to make sure people understand AI offers enormous benefits, enormous opportunity. A lot of it still remains to be seen, and it has huge risk. And it's our job to guide this incredible moment of change in a way that lifts all boats, make sure that we mitigate the downsides to it. So it's too early to tell, I think, is the short answer. There was all these predictions about huge job loss. Certainly it'll be disruptive, but in Pennsylvania, there's enormous growth in these skilled labor, electricians, welders. You can't get enough of them. And the white-collar job loss has not materialized yet. So too early to tell in terms of what the impact's going to be, but I think because of the uncertainty, that'll hopefully lead to careful decision-making before we make any moves.
But, Senator, the job apocalypse that everyone was worried about, apocalypse.
Did you make that up?
Yeah, no. That came from AI companies themselves, not China.
Yeah,
they were the ones that are saying that this is going to ruin jobs.
I think this, go through every moment of profound change, technological change in history. There's a doomer narrative, which I think is very misplaced. I think it's scared a lot of people. But I also think we shouldn't be too Pollyannish. This is a moment of a lot of change, and we have to guide it. It has huge national security implications. We have to be in the lead from a U.S. perspective vis-a-vis China. It offers enormous opportunity in life sciences and health. And on the productivity and job front, I think we're learning a lot as we go. Literally, the job creation that I'm seeing on the ground from energy infrastructure, from data centers, is just absolutely remarkable. And I lived through the internet boom, and what we saw there was some of the same predictions. It wasn't quite as consequential, but there was predictions about how this would destroy certain business models. That was true, but it also created all sorts of new business models. I suspect we're going to see that as people become more comfortable with all the power that comes with AI. There's going to be new businesses and new job creation that comes along with it, in addition to people that build things, because people that build things are in high demand. It's the great irony of this moment of technological change. It's putting more and more emphasis on people who can actually create the infrastructure of the future.
To Annmarie's point, though, this narrative has come from the likes of Anthropic. What's in it for them? What do you think is in it for them?
Well, I'm not going to speculate on motivations of any particular player, but I think...
Don't we need to interrogate the potential motivations, though, of these individuals that run very large companies that can have large consequences for this economy?
Well, you could imagine efforts to shape the regulatory landscape, depending on what relative position someone's in. You could imagine that by positioning yourself as someone who's seeking to protect against the downside, there's benefit from a strategic perspective, from a marketing perspective. So I'm not going to impugn anybody's motives. I will say, I think a one-sided story about AI is really both misguided and really damaging to America's ability to lead and compete. And that's not to say that we shouldn't have a fully, rich and honest conversation about all the possibilities, but it offers enormous potential. And in the history of humankind, these moments have created unbelievable prosperity, and I think this is another. This may be, in all of our lifetimes, it's certainly the most consequential thing that's happening, but it may be the most consequential thing that's happened in humankind. I mean, this is amazing, the pace of change.
I know you're a free market supporter. What do you make of this administration taking equity stakes in some of these AI companies?
Well, I think I'm a markets person, I'm a free market person, but I think we sort of lost the narrative to some degree. And I saw that particularly during COVID, when we were dependent on others for semiconductors, for pharmaceuticals. We had let our commitment to markets essentially make us dependent. And so I think that there are certain industries, certain technologies, certain capabilities that we really do need to have control of, need to have at home. And so the government playing a role in ensuring that's the case is, I think, is good, makes sense, good common sense. I think the problem is the slippery slope. So you have to be very thoughtful about where those lines are. What really is a necessity from a national security perspective, and what is ultimately can be done and contributed.
Just quickly, they're talking about taking an equity stake with maybe Anthropic, but the DoD has it as supply chain risk. How does this make any sense?
Well, you have a pace of change where new models are being created that pose new challenges and new risks. So I think the government is quite rightly wrestling, and the Trump administration is wrestling with how to play a constructive role in the safeguards, at the same time not standing in the way of this remarkable innovation, which is so critical to our future. So it's a balancing act. It's going to take us a little bit of a while to get it right. The thing I always say is we shouldn't be setting precedents or putting any policies in place that we as Republicans or conservatives wouldn't be comfortable with the next team if the next team isn't aligned ideologically. So we need to think about this in nonpartisan, apolitical terms. How should the government engage in such a way to maintain leadership, protect innovation, guard against the worst impulses, with a healthy recognition that Ronald Reagan's line about the scariest words that you could ever hear is, "I'm here from the government, I'm here to help you." We need to recognize the government's probably not equipped to get too actively engaged in some of these topics.
Senator, one final word if you can. We brought up Kevin Warsh, new Fed chair. What do you think people are getting wrong about this guy? Because they're already drawing conclusions about what this Fed will deliver in the coming months. What do you think people are getting wrong?
Well, he is a very, very gifted person, and he understands markets, but he understands the Fed. I think he has a reformer's heart, a reformer's instinct. So if you look at the ideas that he's put forward, he's been talking about this for years. He's got a big vision, I think, for the future of the Fed, and he's also very astute politically. So, for example, the task forces that were set up, I think, is a mechanism for creating a blueprint for the future, but also bringing people on board. So, reformer, a change agent, but someone who's going to do it with a lot of political agility and success.
Would you like to run one of those task forces?
I've got my hands full.
Busy enough? Thought so. Senator, good to see you.
Nice.
Thanks for spending some time with us. We appreciate it. Senator Dave McCormick there. Next on the programme, the race to fund AI.
AI is a $50 trillion economy because it's all about human productivity. And roughly in the world, there's about 110 trillion GDP, and about 60% of that is labor.
Nouriel Roubini joins us next, live from New York City. You're watching Bloomberg TV. Live from New York City this morning. Welcome to the programme. Under surveillance this morning, US firms racing for cash to fund the AI build-out. Big tech spending on artificial intelligence expected to surpass $700 billion for the year from just a handful of companies. Nouriel Roubini of Roubini Macro Associates writing, on this trajectory, US exceptionalism strengthens rather than fades. Equity valuations need not rest on bubble dynamics and should deliver solid returns despite episodic volatility. Nouriel joins us now for more. Nouriel, good morning.
Good morning.
Really beautiful moment with Senator Dave McCormick leaving the studio, you coming in. He said, you're no longer Dr. Doom anymore, you're Dr. Boom. What's changed?
What changed has been essentially the most important technological innovation in human history. While everybody's talking about AI and Gen AI, this is only one of the 12 or more industries of the future. You have AI, you have semiconductors, you have robotic automation and humanoid robots. You have fusion energy, you have quantum, you have defense tech, you have space exploration, fintech, agtech, you have new material science, new cryptography. Really, it's a Cambrian explosion of innovations, each one of them, I have to say, powered by AI, but they're separate verticals, very separate industries. Space exploration, exploitation is separate from AI, even if it's fed by AI. So I'm going to see US potential growth for the last 2 decades has been barely 2%. I expected that by the end of this decade it's going to be at least 4%. And the data already suggests that productivity since COVID has doubled in spite of COVID. It's already closer to 2% plus. And with potential growth higher, there'll be a significant increase also in equity market returns.
How concerned are you about bumps along the way? Christine Lagarde talking about the financial risk that comes along with the likes of Mythos or some of the technological advancements that could potentially torpedo the financial system, the payment system as we know it. I mean, how much is that potentially a risk on the way to this much more prosperous future?
Well, there are two types of risks. You know, I wrote a book in 2022 about mega threats where I spoke about stagflationary risk, things that reduce growth and increase inflation, while technology does the opposite, increases growth, reduces inflation. Of course, having tariffs, having restriction to migration, having large budget deficits, playing with the independence of the Fed, the rule of law, you name it, all those things can be actually reducing growth and increasing inflation. And there are risks coming from AI, existential risk or risk having financial types of instability. You know, I've said since April of last year that tech trumps tariffs because the impact on growth of tech is 200 basis points, in my view, going from 2 to 4%. And if you add in a realistic scenario where market discipline constrains bad policies, because it did constrain them, then the downside from bad policies at best 50 basis points. So it's a ratio of 200 to 50, 4 to 1. So tech trumps tariff. And I said also tech trumps temper tantrums too, because all those things are constrained again by market discipline. Every time he's in tallow mode, lashes out, then the market punishes him and it goes back to chickening out. It happened after April 2nd, it happened after Greenland, it happened after the war with Iran. So market discipline is a very powerful force to constrain bad policies.
Do you think it's appropriate for the Fed to hike once or even twice?
It's possible. I would say the economy is going to strengthen. Inflation probably is going to slow down because now oil prices are not 100, they're closer to 80. And therefore food prices, fertilizer, things are going to gradually fall, even if there'll be bottlenecks. So it's kind of like a close call. But I would say it doesn't really matter very much because, you know, the economy is powered by AI and technology and these massive tailwinds, and they don't depend very much on policy rates. If policy rates are 50 basis points higher or lower, I don't think the tech boom is going to really matter very much. And we already saw during the war with Iran that when oil was at 100, the stock market reached all-time highs. In spite of that, in spite of worries about what the Fed does. So I would say people obsessed with the Fed, whether it's 50 basis points higher, whether it's right now, what's the difference? The key story is tech boom. And that's going to be the most important first-order impact of anything else.
That's the headline from this conversation, Nouriel. Always fantastic to catch up with you, sir. Just to beg the obvious question, what does hiking interest rates actually achieve?
Well, and right now, the stock market seems to be moving on. Does it actually slow anything down? Ultimately, a task force will answer that question, John.
You want to run a task force? Do you fancy that?
You know, he wants to change things, but I would say one important point.
He argues 20 seconds, so one very quick important point.
He argues that because of productivity growth, Fed funds rate should be lower because inflation is going to be lower. But if potential growth is higher, the equilibrium real rate, both short and long, is higher. So there's a bit of a wash on the policy rates and on the long rates.
Nouriel, well said as always. It's good to see you. Thank you. Nouriel Roubini there of Roubini Macro Associates. Up next, Seema Shah of Principal Asset Management, Amy Gower of Morgan Stanley, James Egelhoff of BNP Paribas, plus Eric Johnson of Cantor Fitzgerald.
We still think tech is the dominant theme of this bull market.
Equity earnings will always drive the market.
The concentration in S&P has gotten pretty high.
There could be a near-term correction.
It'll be a broader rally from here going forward.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. We're down 0.1% on the S&P 500, positive on the Nasdaq 100 this morning. In the bond market, reopening stateside after a long weekend, yields are higher by 4 basis points, 422 on twos, a new high for the year. On tens this morning, up 3 to 450. Let's round this one up. Going into this later this week, PCE data, a read on inflation, the Fed's preferred read on inflation, at least for now. Before we get to that, we'll get some headlines from various Fed speakers through the week, and that's going to be an indication of where they stand on current policy.
Yeah, later this morning or later today, Fed Governor Chris Waller, a real question about how much they'll coalesce around the less is more strategy, or whether they'll give some guidance maybe behind those 9 members that voted for some sort of rate hike later this year, or at least as the next move. Look, this is going to be a difficult one. And ultimately, how much does the market keep listening to some of the individuals versus the head of the Fed that it clearly had a more, or not so clearly, maybe had a more hawkish message? I mean, he didn't push back against the hawkishness, but you raise a good question. Who is he, given the fact that we ultimately didn't really get a call from him?
There has been a perceived shift. I think we can call it that, right? A shift in perception given the amount of rate hike calls we've seen subsequently. One from Deutsche Bank, they're looking for hikes this year. Bank of America as well. Question we've all been asking, are we confusing a lack of guidance with a hawkish shift at the Federal Reserve? And for clarity, you're going to look for other officials when the Fed chair is not providing it.
Yeah, the one indication that Kevin Warsh did guide was the sense that inflation was preeminent and the preeminent concern, and that it wasn't necessarily a dual mandate that was in conflict. That until you get price stability, you don't have the ability to create a labor market that is a robust one. So in other words, there isn't a situation where you could have that dual mandate in conflict, and he is purely focused on the inflation side of what the Fed is dictated to do. So here comes the question about Chris Waller, as well as what we get from John Williams. How much do they support him? How much do they speak about their positivity toward the new approach and some of the reforms? Because ultimately that is going to determine how much it will be a committee led by Kevin Warsh rather than a committee of lots of different ideas.
When's the Governor Powell speech? Looking out for that one. It's not in the calendar.
I haven't seen it yet, yeah.
Low profile, I'm told. Let's see if it keeps a low profile or not. Let's bring up crude, WTI and Brent this morning. We're lower by close to 2% at the moment on Brent, in the 70s at 79. WTI down 1 percentage point at 75. We heard from the Vice President, J.D. Vance, out of Switzerland 1 hour ago. Constructive tone coming from him.
Very constructive, which reiterated what the Iranians said as well, which said they made major progress when it comes to the talks. The fact of the matter is, for the oil market, we actually are seeing more barrels hit the market. CENTCOM talked about that over the weekend. You're also seeing Iranian crude on U.S. sanctioned vessels that seem to be openly moving. So more barrels are hitting the market. And also the Joint Maritime Information Center just put out a security threat level, moving it in terms of the Strait of Hormuz and the Gulf of Oman lowered to moderate following what's going on. So basically giving the green light to all these vessels that have been stuck, that it is now safer to try to go through the Strait of Hormuz and get out of this. So the next 60 days.
We're seeing the barrels move.
Yeah, and so the next 60 days, this is where we're going to be. The issue is, of course, going to be if we get to the end of the 60 days and things are really not progressing on the talks. But right now, it is looking somewhat positive.
WTI 75, Brent crude around 79. Coming up this hour, we'll catch up with Seema, Shah of Principal Asset Management. With inflationary risk pressuring markets, James Egelhoff of BNP Paribas on how the Fed could hike rates as soon as next month. Plus, Eric Johnson of Cantor Fitzgerald bracing for volatility just around the corner. We begin this hour with stocks holding steady as investors await another key week of inflation data. Seema Shah of Principal Asset Management writing, the near-term inflationary implications of the AI capex cycle remain underappreciated. Investors can position for both opportunity and resilience. Seema joins us now for more. Seema, good morning.
Good morning.
Should we also position for rate hikes?
I think this starts to come hand in hand. We've seen oil prices come down more than people were anticipating. That's been very clear. The thing that we don't think has been appreciated to this point is that when you look at the PPI inflation numbers, which, as we know, were very, very hot, the things that are really driving it, it's not just the oil, it's actually some of the capex build out. So what's going into data centers, the shortage that happens with corporates, with copper, natural minerals, those things are all there, and that doesn't look like it's going backwards. So from our perspective, inflation certainly looks structural, there's higher inflation. So maybe it doesn't have an impact in the next 6 months or so, but as you're looking at over the future, this does suggest higher rates.
Well, let's sit on the sequencing of things, because some economists are pondering the idea that up front it's inflationary, or the AI spend. Further down the road, the technological developments become disinflationary. Do you see it in quite the same way?
We do. So when I say about, over the next 6 months, as Kevin Warsh and the task forces are debating what's going on cyclically, that means that to us, maybe rates are going to stay on hold. But if you look at over the next year or so, you get to the end of those task forces, oil prices have come down, but what if PPI hasn't come down with it? At that point, the question becomes, is this a story which is more than just geopolitics, and do we need to really focus on the AI build-out? But to your point, if you're looking out beyond the next two years, 5 years, then it's certainly, to us, it does look more disinflationary.
If you have a Fed that is more willing to hike, at least perceived to be so, and you have the technological boom that we've been talking about for weeks and months and years, frankly, why wouldn't you then have that much more confidence to go into U.S. dollar-denominated assets once again?
I think there is. I mean, as we're going around in Europe, for example, there has been real hope, of course, at the beginning of the year that this was the start of a new cycle for European markets. The war put a halt to that. And even now, although you're seeing people talk about the catch-up, there are still really long-term question marks around what happens with regards to European investments over the long term. There is a sense of real skepticism and need to see proof that the data surprises are turning to the positive, but also that they're able to join in some of the secular forces that are going on. So defense, energy security, AI infrastructure, those are really key in order to ensure that Europe can stand on a similar stage to the US.
Have you repositioned at all your portfolios since the sort of pivot from, or at least perceived pivot from Kevin Warsh, as well as some of the earnings that have continued to deliver in a very strong way, despite some of the skepticism earlier this year? Has it sort of made you reallocate a little bit more?
We haven't reallocated it, but it is a debate which continues to go on about how much international exposure we want to have. I mean, international specifically, the question marks about Europe. We long-term believers in tech, so the overweights have really been in large-cap US and parts of Asia. But we had come into the year hoping that Europe would do well. We pulled back off the back of the Iran war. And this is the point that we're still not there yet, that we're thinking that we need to see a little bit more evidence. But also, this isn't a macro story in Europe. Increasingly, if you want to invest in Europe, you have to pick the right sectors. Where are the secular drivers? Where is that push going to be coming through, which can carry stocks beyond some of the maybe cyclical moves that we could see over the coming years?
It feels like Wall Street has moved on from the Iran war, but is that different? Is it only on this side of the Atlantic, and you're not feeling that really as you're based in London?
Yeah, I think that's true. I mean, and that makes sense given the vulnerability within Europe. There is a sense of optimism, though, that this was the hurdle that we needed to cross. But then after the hurdle passes, then you have to question what else is there beyond the relief trade.
When it comes to what's left then, so say we are in earnest moving forward, does that excitement come back to Europe? And where?
I think it's potential. I think we have to really be watching. I mean, the data has been worse than expected, I think, coming into the war. So it's really about seeing, does the data surprises turn to the upside? And then can we see the growth coming from governments going into the right places? To this point, there is some disappointment about where it's been focused. And so I think that's going to be, again, really key for deciding how much allocation we want to have to Europe.
It's been a busy morning already, getting these headlines from SpaceX. Let me bring you the latest development, widely anticipated. Many people called for this. Debt offering from SpaceX just a few weeks following an IPO.
Yeah, so they really are out there trying to raise as much money as possible. Last week, they were preparing for a bond sale of at least $20 billion. The idea was to pay down a credit line that they already had, and it followed their investment-grade bond rating or company rating from the likes of S&P and Moody's. Now they are delivering on it. It just highlights how quickly they are grabbing as much cash as they possibly can, how quickly they're moving to make acquisitions. You saw the acquisition of Cursor, how quickly they are just trying to hoover up as much capital as possible to bring us to Mars and beyond.
Seema, the race for capital. The stock is down by 4% this morning, by the way. The race for capital. How are you processing the race for capital? How do you internalise this moment when many people that come on this programme are worried about the supply side of things, picking up just a little bit more?
Yeah, it's a big question mark, and I think that's where, from a credit side, you have to be doing the research. And so far, look, there's very little indigestion. Our fixed income team are quite positive in thinking that the market get through this. You need to have the strong macro backdrop still. But I think as we look over the coming years, the question mark around potential bubble euphoria does continue to build up. And that, to us, beyond Europe, of course, is a question. How far is this going to go, and what can we do to hedge against a potential problem in AI coming up?
Well, the issuance is certainly picking up, not just on the equity side, on the debt side too, and has been all year long.
It just highlights, again, how much one market is not going to really pack the coffers of any of these AI companies. They need to tap every market. They need to tap the debt. They need to tap the equity. They need to tap the asset-backed market. They need to tap the international markets. You see them going around the world. At what point do we get a yen-denominated SpaceX deal? I mean, at a certain point, you start looking at this and you start wondering, OK, at what point will people start to push back? At what point will it be enough capital? At what point are they racing each other to pay the highest prices for the semiconductors? Welcome Micron on Wednesday when they report earnings.
To your point, I think you touched on the right thing. SpaceX has taken advantage of a massive equity cushion that other companies don't have. And this is the point that I think that we're all trying to make this morning, that these companies have a moat here. It's a financial moat. They're able to raise capital in ways that competitors just can't get near.
This should be an issue increasingly. How do you get potentially enough competition if you have this sort of moat, as you're talking about with these? Microsoft is talking about, Satya Nadella. He was actually in this Wall Street Journal article talking about how he expects there to be another winner that comes out, and pushing back and hoping that there can be others coming in, of course, as he potentially does lose some dominance versus Anthropic and other models.
Timing's curious of that piece this morning.
Obviously, right? You start to wonder, but you start looking at some of this and you start wondering exactly how big some of these companies can actually get.
Do the big just keep getting bigger? Or will we see that disruptive force coming from somewhere else?
I think you're going to see a little bit of both. You know, those, as you said, those big companies are taking advantage of this moment in time Can they continue to do that? Does the market continue to support this kind of movement? I think it's questionable. I think this, I'm a macro strategist, but I can see that this is becoming more of a bottom-up market where you have to really understand the fundamentals for each specific company. At what point do investors start to lose interest?
Seema, it's good to see you. Not losing interest here at all. Seema Shah there, Principal Asset Management. SpaceX kicking off its debut US dollar high-grade bond offering, widely anticipated by so many people heading into that IPO. And here it is following it, the debt offering closely follows that IPO from just a few weeks ago. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Former Federal Reserve Chairman Alan Greenspan has died at 100. Greenspan served 5 terms as chairman of the Fed under 4 presidents. He led the central bank for 18 years and was credited with guiding a record US economic expansion. Keir Starmer announcing his resignation as UK Prime Minister. Starmer's exit opening the door for Britain's 5th Premier since 2022 and paving the way for potentially Andy Burnham to take over after the longtime Mayor of Manchester won a parliamentary seat last week. In sports, a jam-packed weekend of World Cup action. Spain breezing past Saudi Arabia 4-0 and Germany coming back to beat the Ivory Coast. Cape Verde continuing their surprise one with a draw against Uruguay. And Team USA off to a flying start, beating Australia 2-0 to secure a spot in the knockout stage. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. No World Cup rant this morning.
Really?
No rant at all.
Well,
no.
OK, but
US Open?
No rant at all.
All I can say is Australia plays it like rugby.
I was disappointed in FIFA that they didn't lean into the college football spirit in this country, the tailgating, etc., making the games more accessible. But I've been so happy to see the following thing. I love many things here too. Football in this country. To see the Europeans and global football fans fall in love with this country. As all these politicians worldwide are having their own argument, forget them. To see them fall in love with this country has just been such a joy over the last week. To see the Scottish take over Boston, to see the people of Boston fall in love with the Scottish. I think that's been just the key piece of this World Cup that I've really enjoyed over the last 2 weeks.
Did you see that Boston ran out of beer?
Yes.
Okay, that was the best part of this whole weekend.
Right, Freddie.
We should invite Freddie on.
I mean, we could do that.
Freddie, the German tourist.
He's amazing.
The whole thing's just been awesome. Okay, so no World Cup run.
I think that's fabulous.
Just a celebration of the moment.
I think that they had Bud Light left, but the Scottish said that's not beer.
No, there you go. Despite FIFA's best efforts. Up next on the programme, the Morning Calls plus Amy Gower of Morgan Stanley on the outlook for gold as central banks pile in and Wall Street pulls back. That conversation up next, live from New York City this morning. Good morning.
Go through every moment of profound change, technological change in history. There's a doomer narrative. This is a moment of a lot of change, and we have to guide it. I suspect we're going to see that as people become more comfortable with all the power that comes with AI, there's going to be new businesses, new job creation that comes along with it.
That was the constructive view on the future of technological progress in this country. The Republican Senator Dave McCormick on the programme a little bit earlier on. Some misinformation. It's basically what he told us about what this technology will do.
It's not going to take away all your white-collar jobs, and if you want to be a plumber, well, that can be a really good thing, too. And it's not just a plumber, it's also an electrician and other things. And people have actually written in and said, why do you always give plumbers love? You know, it's because I've recently
He specifically mentioned plumbers, though.
Yeah, but look, this is the positive case. Question is just the narrative, right? The sequencing as well. Do we get the inflation before the disinflation?
The supply of plumbers that we could see in this country
because of
the
me?
next few years, not just because of you. You can take some responsibility if you want. Looking forward to tracking those numbers in the years to come.
Yeah, and the decline in college degrees as well, because right now people who are going into some of these more technical fields are making a lot of money, and people with college degrees aren't necessarily getting jobs. So there's going to be a recomposition of the labor market, and how we navigate that's going to be key.
I'm looking forward to that turn in the power, that colleges will now have to justify the expense of a degree, and the change in approach that we might see from some institutions that struggle to get by?
As the mother of children entering that phase and ready to fork over however much money, I completely endorse that view.
And these colleges with these massive endowments, and then you graduate and then they call you and ask for a donation.
Oh, that's amazing.
I can never get, like, I paid the money to get in.
No, it's,
and
but you're
the
paying
tuition.
it forward and all of this, but you have to
Isn't that what
justify
the endowment's for?
Yeah, well, yes, this is, well, look, we'll get into all these discussions, I'm sure.
It's all for data. They want to say X amount of alumni give back. So even if they're like, give a $5, they want to put your name part of the alumni that give back. That's the whole, it's a whole shtick, John.
OK, I don't quite get the shtick, but it's a shtick. Equity futures right now in the S&P just about unchanged. On the Nasdaq this morning, positive by 0.2%. That's the price action. Let's get you some morning calls. First up, KeyBank initiating coverage on SpaceX with a sector weight rating, seeing a balanced risk reward. Elsewhere, Wells Fargo trimming its price target on Kroger to 58, calling it a tough stock to own with a choppy journey ahead. And finally, Needham, more than tripling its price target on Micron to 15.50, seeing strong fundamentals on high demand and a robust pricing environment. The stock is up again. That's the name to watch heading into earnings this week.
To me, this is going to be the key name going forward. How much can they continue to rise upwards some of their expectations, given how much semiconductors have outperformed, particularly this name? I mean, what has it been over the past year?
I've lost track.
I mean, it's been like 800% or something bonkers as people take a look at this transfer of wealth from the hyperscalers to the semiconductors.
Vertical. That's what that chart looks like. Let's talk about commodities. Gold pushing higher after 3 weeks of declines. Investors turning back to precious metals as peace talks press on between the US and Iran. Amy Garr of Morgan Stanley writing, de-escalation in the Middle East supports gold, but a more hawkish Fed brings challenges. We retain an upside bias, but the route to 5,200 looks more challenging. Amy joins us now for more. Amy, welcome to the programme. Let's talk about the house view first. When it comes to rate hikes, rate cuts, where are you now and what does it mean for gold?
Yeah, look, the Morgan Stanley house view is for the Fed to stay on hold through 2026. So slightly different from, I guess, if we look at the implied market pricing, which is now showing about 1.6 rate hikes by the end of the year. And whatever happens with the Fed is going to be highly instrumental for the path for gold from here. In particular, if we think about the exchange-traded funds, which have been a huge part of gold demand, nearly as big as the central bank buying last year, what we find is they do track very closely what the Fed is doing. So I think, if we are in a situation where the Fed is on hold, that is a more manageable backdrop for gold. But if we are looking at hikes, I think we probably would expect a bit more ETF selling to happen from here.
Amy, the big tailwind, as you know, over the last several years has been central bank buying of precious metals. In many ways, going back a few years, that was the tailwind for this bullish trade. How does that stack up now?
Yeah, look, I think what we had in 2022 was really a structural shift in central bank behaviour. So going from buying about 500 tonnes a year in the previous decade to buying now 1,000 tonnes a year or so. We had 860 tonnes last year, so a little bit lower. But we still think that kind of fundamental shift higher remains in place. Obviously, what we had, though, with the Middle East conflict is a bit of pressure on quite a lot of oil importing and gas importing countries, either currency or fiscal balances. And so what we have had is a bit of selling pressure, and notably from Russia and from Turkey, and potentially others as well. So short term, actually, we've had a bit of a headwind to that central bank engagement. But we do think, especially if the conflict de-escalation continues, banks will re-engage. And actually, it's a much better price level now. We've seen already China's PBOC take advantage of this. So they've actually bought more gold in the last 3 months than the previous 12 months combined.
Amy, it hasn't just been central banks. It's also been hedge funds and other institutional investors that are looking for diversifiers at a time where they're concerned about treasuries as a haven asset. That bid seems to have been challenged over the past couple of months, given the fact that in times of stress, gold sold off. How much do you see that trade coming back on, or has gold's image of some sort of ballast of stability been shattered as a result of what's happened?
Yeah, look, I think what the market has come to the realization of here is that gold is a much better safe haven in a demand shock than in a supply shock. So this was very much a supply shock, which tends to bring with it higher inflation expectations and obviously the subsequent change in bond yields and rate hike expectations that come through with it. Whereas in a demand shock, what you tend to get is worries about growth and those bond yields going down. So bond yields going down is much more of a tailwind for gold than bond yields going up, as we've had this time around. So I think it has has kind of reminded investors that gold isn't always a safe haven, particularly it's more challenging in a supply shock, especially if there isn't anything else going on to support the price. I think, look, from here we are seeing, I guess, a bit more interest to re-engage, but I think just trying to think about what that next catalyst might be. I think we will continue to see gold perform on these de-escalation days, but obviously we're going to be still quite sensitive to Fed narrative, incoming inflation data, and other measures in the US as well. So that might be just a little bit less than last year, where gold was just kind of one big trade up and everyone was kind of trying to jump on that bandwagon.
Central banks aren't just stockpiling gold. I mean, countries in general are looking to stockpile critical minerals and a whole host of other assets that are potentially crucial in the build out of artificial intelligence. I'm just wondering how much you're seeing that stockpiling accelerate during a period of time when potentially there's a little bit more calm in the Strait of Hormuz.
Yeah, look, I think this is a theme that is here to stay and is only going to accelerate. So we've written about this a couple of times in the last few months. And when I was kind of putting together the second note, I was having to add new sort of news stories every single day on this topic. So we're getting a lot more focus on stockpiling. We've heard from China, for example, that they're looking to accelerate the build out of sort of where they're actually going to store stockpiled materials. We've seen Europe adding tungsten and rare earths and a couple of others to their sort of intention to stockpile. So I think we're going to just see more and more here. It's probably starting in some of the more minor metals rather than straight to sort of the base metals. But then what we should also remember is, although it's not strictly a stockpiling strategy, the US has built a very large onshore stockpile of copper, for want of a better word. And so that is also having big effects in the copper market.
Amy, good to see you. Appreciate the update. As always, Amy Guha there of Morgan Stanley with gold this morning at 42.11, the high of the year. $1,000 plus north of that. We've seen a big move lower over the last few months.
Yeah, and this has come even with a risk-off move. And what Amy just said is that gold tends to act as a good diversifier in times of a demand shock, not a supply shock, similar to what bonds are. But then you start to wonder, how much are they actually a hedge that bonds can't provide if they move pretty much in tandem with risk assets and with bond yields?
Yeah, to your point, gold and this whole explosive rally correlated pretty well with risk, positively with risk assets, largely because of that shift we saw in 22, or at least that's a factor. The central bank buying we saw of gold diversifying away because of the geopolitics of Russia, Ukraine. Big factor in the gold story up until recently. Coming up next, we'll catch up with James Aguilar of BNP Paribas, expecting 3 rate hikes from the Walsh Fed. We'll get into that call in just a moment. Plus, Yahira has some morning movers. SpaceX once again in focus, kicking off a debut US dollar high-grade bond offering. Out of control in the commercial break. OK, let's get back on track. You guys done? Good. Futures positive on the S&P 500, just about unchanged. On the Nasdaq this morning, we're positive by 1/3%. An uplift going into the opening bell about 60 minutes from now. In the bond market, getting a lot of calls now, lining up for rate hikes. We heard it from BNP. We'll catch up with them in just a moment. We've heard it from Deutsche Bank and Matt Lassetti. We've heard it now from Aditya Bave over at Bank of America. They're looking for 75. 3 hikes starting in September. That could make Jackson Hole look very interesting in August.
Yeah, especially if the task forces come out with some conclusions about exactly what the drivers of inflation are. That actually might be the task force I'm most interested in right now, because there are different drivers and there are nuances to which rates affect which parts of the economy. And if you have a multi-speed economy, how do they use one blunt tool to affect that? And that, I think, is going to be a huge discussion. Jackson Hole is going to be actually fascinating. Let's see if it actually is a speech that he delivers, or whether they decide the communication
or if he even goes.
Yeah, well, I mean, maybe he decides that communication is no longer necessary. But clearly, going forward, this is going to be a clear focus.
Speak when you have something to say, right? Speak when you have something to say.
The task forces should be done by then.
Possibly, yeah. Just getting inflation data from Canada, 3.2%. For the month of May, year over year, the estimate was 3%. I bring that up because the inflation story right now is fairly universal. It's not just unique to the United States. In fact, what is unique to the United States right now is that we have inflation that's above target at the central bank. We also have growth that's pretty robust and decent too. That's something that Canada does not have, something the Europeans more broadly don't have either.
And it's part of the reason why people are anticipating rate hikes, even though oil prices are going down. This isn't just an oil price story, and that has come clear from what we've seen in markets and what we've heard from commentary out of Fed.
As we count you down to the cash open, we'll get more commentary from the Federal Reserve later this morning. Governor Waller, about 30 minutes away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Well, apparently a $75 billion raise was not enough for SpaceX, the company saying just this hour that they have kicked off its first bond offering. We reported last week that it was seeking to raise at least $20 billion, though SpaceX itself has not disclosed the final size of the deal. But what this filing does confirm is the investment grade rating that we reported it had gotten. Shares still lower in the pre-market, down 4%, on track for a third straight session of losses. Turning to the chip stocks, they are on a tear this morning. We are seeing names like Micron and Western Digital up in the pre-market ahead of Micron earnings on Wednesday, and Intel still riding high after President Trump's comments that it is working with Apple on chip design and manufacturing, though the company itself has not confirmed that. And we end on a deal we talked about earlier, but it is now official. AbbVie is buying Apogee Therapeutics, so those shares are up nearly 50% in the pre-market. It's a nearly $11 billion deal and would mark AbbVie's biggest acquisition in years. John?
Yahara, thank you. Thanks for this morning. Let's turn back to the Federal Reserve. Hawkish signals from Fed Chair Kevin Warsh igniting a rate hike debate. Traders are now awaiting fresh inflation data later this week with PCE due on Thursday. Bloomberg's Enda Curran has a preview for us. Enda, welcome to the programme. We've seen CPI, PPI. I've got a decent feel for inflation in this country. What are economists expecting later this week?
They're expecting an acceleration, John, in PCE on both the month and on the year. If you look at core PCE, expectations are for an increase of around 0.3% on month, 3.4% it is on year, obviously well above the Fed's target. The PCE indicator is the gauge that the Fed really likes looking at, of course. The price pressures are expected to come from, like Lisa said, not just oil, that will be reflected in airfares, but also healthcare costs are expected to show up in PCE. And of course, along with the portfolio story, portfolio management fees, that's linked to the stock market boom. But if we do get those fairly hot PCE numbers on Thursday, it will just cap a bad month for the inflation data in the US. Remember, the headline numbers came in at a 3-year high for the month of May. It all leans into why the Fed has taken on the hawkish tilt that it has.
Well, Enda, let's talk about that hawkish tilt. At the moment, the market is drawing its own conclusions on what this data means for the future of Fed policy. The communication we've had from the Fed, statement super short, very condensed, took a lot out from the previous statement from this Federal Reserve under different leadership. And then we had very limited information in the news conference. In fact, the total absence of any forward guidance across the statement and through the news conference. And conversation we're having up in New York around Wall Street, Enda, is whether we're mistaking a lack of guidance for a hawkish shift. What does that debate sound like down in Washington?
I think that's fair, John. A lot of the commentary I've heard and people that we speak to here make the point that it's a hawkish Fed, but it's reflected that the FOC has turned hawkish. We don't necessarily know where new Chairman Warsh is on that spectrum because, to your point, he's very reluctant to give away too much. He doesn't want to signal where he is on the inflation story. I mean, for example, several of the questions last week during the press conference when he was asked, he responded by speaking for the committee. So we don't yet know. I mean, on paper, it's certainly a hawkish Fed. We know that half of the FMC combined last week signalled in their dot plots that interest rates could go up this year. The question is how hawkish that remains as the months go by. You know, the energy story is changing. That will take the sting out of the inflation, headline inflation at the very least, John. It's a story that won't become clear for a few more months yet. We'll have to see how persistent the AI demand story is on inflation, how services is on inflation, and the other pockets are, and if that is enough to get the Fed over the line. But I agree with you right here, right now. Yes, it's a hawkish Fed. We just don't know quite how hawkish the chairman is.
Looking forward to your coverage, Enda. As always, thank you, sir. Enda Curran down in Washington, D.C. If you want to find consensus on the committee, just make the statement really short. The less you say, the less you need to agree on, right? That's basically what happened last week.
Yeah. How do you get people not to fight? Don't actually communicate with them.
Right. And then they're going to communicate anyway through the week.
Do they fight with each other? Do they have a family spat? By talking past each other, by talking to us. Please, go ahead. You can talk to us.
So Senator Dave McCormick, I think, made a really interesting point on that. He's been quite close to Kevin Warsh throughout this whole process of getting him confirmed down in Washington. And he said, look to the news conference and what he said about that, the family spat. We were talking about the concentration of power. Would he try and concentrate things around his view? That's not what I got from the news conference last week. That's not what I've got from his communication so far. Maybe he's open to the cats in the bag, but maybe doing it behind closed doors, possibly, and less in public.
Doing it in a diplomatic way with these task forces, which is let's get the data, let's get an understanding of exactly what the best practices are, and frankly, talking to issues that people have been talking about in this market for a long time. Does CPI or core PCE accurately reflect the inflation that people are feeling who are more tied to interest rates at certain levels? I mean, all of these kinds of things are things that people on Wall Street talk about. You codify it, you formalize it, and it doesn't become sort of this boogeyman of politics, and it becomes something a little bit more scientific.
And also, as you said, there is a task force for communication on what is appropriate, in all seriousness, what is appropriate to communicate to financial markets and what is not, because he doesn't want the reliance constantly to be the financial markets have, that continues to have when it comes to Fed speak.
The economists are placing their best bets right now, and they're looking for rate hikes potentially starting this year. James Elgahoff of BNP Paribas writing the following. While our base case is for the Fed to raise rates 3 times in succession starting in December, risk is building towards an earlier start as soon as July. James joins us now for more. James, good morning.
Hey, good morning.
Shout out to you. I think I go back to April, the note you put out and said the risk was rising of a rate hike here, largely off the back of the shock in the Middle East. But this call is not just about the shock in the Middle East. Now everyone's coming to you and kind of overshooting. They're calling for hikes, but maybe really quickly. Where are you now?
So we have our rate hikes starting in December. We have 3 after. We have 2 after. So we tend to think that we're going to lift another page from the late Alan Greenspan's playbook. Last year, the Fed cut rates 3 times, saying the economy was weak. Unemployment was going to rise, inflation was going to slow. Is not where we're at. It's just like after 98 in LTCM. We think we're in 99 now. The Fed is going to begin by taking those rate cuts back, getting monetary policy to a less stimulative stance, and ensuring the labor market doesn't overheat, ensuring that we don't have a little bit too much of a good thing.
So characterization is important here. Are you suggesting they'll say this is a removal of the insurance that we took out over the last year, the last 2 years, as opposed to actively starting the tightening process, a tightening cycle?
No, we think if we deliver these 3 rate hikes, the monetary policy will move to a neutral stance. Right now, we think the economy is doing really well, in part because there's so much stimulus going in. We have stimulative monetary policy, stimulative fiscal policy, stimulative financial conditions, and the stimulative effects of the AI boom on demand. We think that the Fed is looking at this and is starting to see inflation being a bit sticky, particularly in core. It's seeing the labor market start to tighten up, and it's seeing growth that doesn't require this much policy insurance. And we think that they'll start to begin a gradual, normal monetary policy response to that.
Process and communication. Typically, we'd wait for a signal. They would remove the easing bias.
Yep.
They'd go to neutral. Then they'd introduce a hawkish bias. And then somewhere down the line, they'd hike interest rates. Why do you think that might have changed?
Look, we think there was a lot of signal in this last meeting. It's like Greenspan. You have to just listen a little bit more closely to hear it. In this case, he didn't have to listen that closely. The last sentence of the statement, the committee will deliver price stability, not some mealy-mouthed formulation that also talks about the labor market, not saying, well, we think that inflation is transitory, we'll deliver it, but it's going to come anyway. The committee is fed up with inflation. It does not want to be seen as dovish. It doesn't want to be seen as having an imbalanced reaction functioning favoring labor anymore. It's taking advantage of the opportunity presented by the leadership transition to signal a shift in reaction function. Now, look, we need to see follow-through on this. But there is the possibility that with a shift in perception, along with some policy realignment, inflation could get back down all the way to 2% over time.
Can they hike rates before the task forces are done?
So we think the task, look, this is another form of soft, very soft forward guidance. We tend to think that the task forces conclude around the end of the year. We have the midterms between now and then. There's a lot of time to think, a lot of time to communicate. That's why we have December in our forecast, why we still have it there. Now, this is a much more hawkish Fed, particularly last week, than we had anticipated. The market is pricing September. As we noted in our note, there's this mounting risk they move faster than our December call. But we tend to think that Walsh is signaling very softly, and he's not committing himself to it, that if the data allows him to wait a little longer so he can get his act together, start building his processes, building his framework, that he would prefer to do that.
Do you think that financial conditions are essentially greenlighting any kind of rate hike in the near term, given the fact that even with a more hawkish Fed, the equity market is hanging in just fine?
Look, there's a big difference between hiking in response to inflation and hiking in response to really strong growth. Hiking in response to strong growth and an optimistic outlook and a tightening labor market. It's reinforcing the messages the equity market is already pricing. So our view is the Fed can deliver some modest policy tightening, not derail the rally, not derail the expansion. Now, the risk is you get into 99 to 2000, where the Fed does the initial 3, and then it does a bunch more, and it does them super fast. And there's and there's just so many that ultimately derails the expansion. So it's a risk that we're watching. But with 3, just aimed at recalibrating the policy stance, we're not that worried.
Are you expecting the Fed then to come under more attacks from the White House?
Look, that's almost unforecastable what's going to happen on Truth Social. Ultimately, what we think is that the Fed is going to follow its traditional reaction function. It's going to focus on 2% inflation. It's going to focus on the labor market. It's going to mind its knitting, and that ultimately, if it needs to send the message to the White House, look, this is the right thing to do for the economy, then that's what they're going to do.
Saying they will implies they haven't. Now, under Governor Powell, then Chairman Powell, why didn't they? Why has this committee all of a sudden shifted under the guidance of one man?
Look, we don't know, and so we're going to have to. It's a sharper pivot than what we had expected. So this is, Warsh is not explaining it to us in great detail where this pivot is coming from. So we're going to look to other policymaker speeches. I think we're in particular going to look to some of the hawks. So we're going to look to Beth Hammack. We're going to look to Lori Logan. How much is it that you're asking for? You didn't dissent here. It was a 12-0 vote. So what is it? What did you ask for? What did you get? How big is this pivot? How rapidly is it occurring?
That was the right question in the news conference, by the way. Essentially, in very simple terms, why haven't you hiked, given everything you've said and what you've written?
Yeah, that was a great question. And ultimately, he wasn't going to give forward guidance. He wasn't going to give more explanations for it. But it's not just for Fed Chair Kevin Warsh. That really is a question for Chris Waller. That is a question for what we hear from the New York Fed president. It's what we hear from Neil Kashkari later. These are all questions they have to answer. Why such a big pivot now under this new Kevin Warsh
If
Fed?
indeed there has been a big pivot, there'll be some debate about that still through the summer.
Well, the dots did imply some sort of pivot from the previous read. So that, I think, they do have to answer, because that does indicate the move to moving to... This was the first time that they moved away from the easing bias, and suddenly you've got 9 of them saying that the next move is going to be a hike. It gives you a sense of how big of a pivot it really was.
Do you see the dots as a forecasting exercise or a communication exercise designed to title financial conditions? Because it can be one and not the other.
Yes.
Can be both, of course, sure.
I mean, ultimately, it's being used as both, because right now, if you talk to economists, they'll use a dartboard and a dart to give you a sense of where the economy is going to be at any given time, and it changes a lot. And a lot of Fed officials are pretty humble about talking about that. They can give their best guess, which is a reason why, Kevin Warsh talked about the pencil with a big eraser, and they would go in.
The fact that they haven't signals to me they're reluctant to do so, which is why you've got December and not July. Now, others have the summer, I get that, but I still sense a reluctance from these guys.
If they're signaling that there's potential for a rate hike and it's getting priced into the market and the market's fine with it, at what point, why wouldn't they? And how much, if this truly is a Federal Reserve that looks at market conditions as an input into their data set, why not say, we're getting the green light right now, because nobody's that concerned about hiking rates?
Well, this is a Christian Guha point over at Evercore, that maybe they get cornered by their own communication. Is that your sense of things?
Look, the dots were invented after the Alan Greenspan era. So Alan Greenspan was a legend even when he was in the seat. It was very hard to disagree with him. Ben Bernanke came in and he wanted to create a more egalitarian Fed, one where more voices could be heard. And so the dots were a way of signaling that, so a way of implementing that. So now what we're hearing from the broader group on the FOMC is that people want to deal with the inflation problem. They want to take a step in that direction. They want to deliver at least some policy tightening. And that's... Kevin Warsh went to the podium. He made fun of the process. It's not perfect, but it wasn't like he pushed back against the message. Yeah. He knew that he came onto that podium, the market would take a hawkish message from that, and he didn't push back. And the market's not pushing back either. Ultimately, it's at the 30-year bond rally. So if we're seeing evidence that financial conditions in the equity market are stable, financial conditions are actually easing in response to a hawkish Fed in the long run, it's telling you that the Fed's getting a green light for markets.
It was a time when they also wanted to signal low rates forever, and we're not in that time anymore. James, it's good to see you. Thank you, sir. Thank you. James Egelhoff there of BNP Paribas. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. SpaceX tapping the debt market. Elon Musk's company selling investment-grade bonds for the first time in what's expected to be the start of a massive borrowing spree. Sources telling us here at Bloomberg it's seeking to raise at least $20 billion from the offering. Chevron signing a 20-year deal with Microsoft to provide natural gas-fired power for a proposed West Texas data center. The power plant is expected to be operational by 2028. Microsoft is doubling down on building data centers to compete with Alphabet and Amazon. Toy Story 5 topping the weekend box office. According to studio estimates, the Disney Pixar film made $160 million in domestic ticket sales. The latest in the series of movies about the secret life of toys comes 31 years after the original Toy Story first landed in theatres. And that is your Bloomberg Brief. John.
Some things make you feel old. Funny, thank you. 31 years since the original Toy Story. Where has that time gone?
That's so sad.
Honestly.
Are you a Woody fan or a Buzz Lightyear?
I was never really big into the movies. To be honest, I know that probably makes me an exception, but I remember when they came out, 30 plus years ago.
I remember that too. They became a staple. And, honestly, the nostalgia that is absolutely banking for Hollywood these days really is notable.
Yeah, people want it back, right?
They want everything back from old. They want it from our times, yeah.
Good times.
Yeah.
Up next on the programme, we'll set you up for the day ahead, plus Eric Johnson and Cantor Fitzgerald on navigating choppiness ahead in the equity market. Live from New York City this morning. Good morning. You're watching Bloomberg Surveillance.
The economy is powered by AI and technology and these massive tailwinds, and they don't depend very much on policy rates. People are obsessed with the Fed, whether it's 50 basis points higher, whether it's right now. What's the difference? The key story is tech boom, and that's going to be the most important first-order impact of anything else.
Nuria Roubini of Roubini Macro Associates. It's not news. This shift has been developing for a while, but Dr. Doom is now Dr. Boom and has been for a number of years.
He was Dr. Boom last year in April, and everybody else was saying, now we're getting to be Dr. Doom, and he was right, so kudos to him.
Futures this morning just about unchanged on the S&P 500. Positive on the Nasdaq, up by a third of 1% as we count you down to the open about some 40 minutes away. Your events this week stacking up as follows. At 3:30 Eastern, we'll hear from the President signing executive orders. Look out for that, particularly given the talks over the weekend. Look for some comments on the latest between the US and Iran and their negotiations. Looking ahead to tomorrow, PMI data, FedEx results Wednesday, the big earnings report, Micron. Thursday, PCE data, another round of jobless claims Friday. UMich consumer sentiment. Let's get back to the market. Stocks hovering near record highs. Eric Johnson of Cantor Fitzgerald writing, we remain bullish on equities, but think in the near term, we're going to enter a period of consolidation and likely increased volatility. Eric joins us now for more. Eric, welcome to the program.
Thank you very much.
What's behind that increased volatility?
So a few things. Number one, new Fed chair. So we know the data. If you look at when a new Fed chair starts, a lot of times you'll see drawdowns over the first, 1, 3, and 6 months due to the uncertainty of the new chair. We have a lot of uncertainty in this case. The second thing is around AI. There are a lot of variables that are emerging. So one of them is around open source models as they start to pick up share. Another is going to be around token maximizing versus token minimizing and how those trends look. The AI CapEx spending. So we've seen all the benefits, right, of the $1 trillion a year of spending that's helping all the sellers into the CapEx. Now it's got to be paid for. So it's been paid for by cash flow and cash on hand, but that cash is declining. And so now it's the reckoning of having to pay for it with debt and potentially, right, we saw from Google, potentially new equity. So, and then the overall equity supply over the next year that we're seeing from IPOs, from lockups, et cetera, as buybacks start to decline. So there are a number of headwinds. However, what we all know is that earnings estimates continue to rip higher due to this AI CapEx build out. We know the economy is very strong, full employment. So there's a lot of tailwinds. There's animal spirits with retail, but there are these headwinds that are starting to match up that I think is going to cause this volatility.
What I hear from you, though, Eric, is the dominant risk, potential risk, comes from within tech, from within these companies, not from outside.
That's exactly right.
It's kind of interesting to me. Yes. We're not talking about the Federal Reserve, Kevin Walsh. We're talking about something else.
The AI CapEx trajectory, I think, is far more important than what's going to happen with the Fed. If you look at the magnitude of this CapEx, right, it's $750 billion going to over $1 trillion next year. CapEx in the S&P 500 has doubled over the last few years. And if you have someone walk in and say, hi, I'm going to spend $1 trillion and all you companies are going to sell into it and make all this money, that is going to be a very powerful force. And that is the driving force around why the S&P 500 earnings are growing at 28% this year. It's not just some great economy random thing. It's due to this build out and the selling into it, and the capex spenders, right, are actually depreciating over 5 years. So their net income is also showing okay numbers despite all the spending.
Problem is, someone's got to pay for it. And right now, Hedgeye put out a great chart showing that share buybacks just aren't happening for a lot of the big tech players because they're using their cash for some of that capex. At what point is that technically going to challenge the rally in the equity market?
So I think over the course of the next year, I think it's going to be, an issue. One of the things that, as you said, has been a tailwind for this market for years has been the $1 trillion of buybacks, a shrinking amount of supply of equity, a shrinking number of public companies, and that mismatch has been very, very powerful. Now, if you look at it, the hyperscalers, Google as an example, right, has been buying back stock. They just issued, Amazon, Microsoft, Meta, are they going to be buying back stock when free cash flow is where they are? And so that's sort of coming down at the same time that equity supply is increasing. That could be a tricky combination. And the individual investor is not set up to take on all this supply. We looked at money market cash and checking accounts relative to the size of the capitalization of the overall market of equities, and it's at historic lows. It's actually equal to March of 2000 in terms of those cash levels relative to the size of equities. And so the ability to absorb all this, I think, is going to become challenging. Timing that is very difficult because a lot of this supply, right, is not coming tomorrow. It's going to take time. There's going to be lockups that need to expire over many months. So we'll see.
Watch out. It's a major consideration for sure. Eric, it's good to see you. Thank you,
good
sir.
To see you.
Eric Johnson there of Cantor, Fitzgerald. Coming up tomorrow, we'll catch up with Julian Emmanuel of Evercore, Neil Dutta of Renmac, Phil Camporelli of JP Morgan, Kate Moore of Citi from New York City. Great to be back with you. Thank you for choosing Bloomberg TV for our audience worldwide. This was Bloomberg Surveillance.